Welcome. You're watching India Market Open and we are set for an exciting Monday. I mean, the number of things that have happened over this weekend.
Crazy.
To impact Indian markets, global markets, world markets, and of course, the new Japanese Prime Minister is the story of the day.
Yeah.
And possibly of the rest of the week.
Yeah, I mean, war action, geopolitical action, China measures, and we're not even, I mean, the quarter has ended with a bang, Tamanna, both literally and figuratively. And there will be massive impact on all kinds of things, including commodity prices and stock markets as well, as the Nikkei is showing.
Yeah, and the Nikkei is showing. Plus, look at September. So, you know, you're ending off September on a strong note as far as India is concerned, as far as US markets are concerned. But October is looking a little. I mean, you have a monetary policy coming in. You have a lot of global factors which now are a little bit out of whack. But so much to unpack this morning, so let's get through it very, very quickly and start with what happened in the US markets. Mixed trade on Friday, but that's not to take away from what has been a stellar month and quarter in the US markets. The Dow was up, but the Nasdaq and the S&P definitely closed down. The Nasdaq down because of a whole host of semiconductor stocks, and Nvidia, for example, was about 2% down in trade. The important factor as far as US markets concerned is definitely PCE, the inflation data that the street watches very closely. That's the personal consumption expenditure index. For August, it comes in at 0.1%, in line with expectation. In fact, for the year, it's slightly below the forecast. The annual number is 2.2%, below the forecast for 2.3%. So now that sigh of relief that yes, what the Fed did was warranted, it's worked out well. Look at bond yields as a result. Bond yields inched up slightly, so at 3.75% is where we saw the 10-year. What I found very interesting is crude. Look at the factors. I mean, Israel and Lebanon, the conflict is escalating. Israel comes and says this is just the start. But the fact that Saudi output is going to increase keeps crude tamped down overall, even after the killing of the Hezbollah leader by Israel. So you have this plus and minus two situations keeping them in balance. NYMEX crude about 0.5% up, and you had Brent hovering around the $73 range as well. But the story this morning is all about Japan. It's all about Japan, and we will, of course, get our guest in a bit. Shigeru Ishiba is the story. He takes over as Japan's next prime minister. It was a surprise. It was not what was expected. He's the former defense and agricultural minister in Japan, a bit of a China hawk, and that was the concern. He's also gone on record to say that he was very happy when the Bank of Japan increased interest rates. And the sense now is that that political pressure which was coming down to stop the Bank of Japan from increasing rates aggressively goes away. So you've seen the yen seesawing, you've seen the Nikkei obviously plummeting this morning, recovering from its lows though, but having a bad time. Plus, this is a prime minister who is likely to increase taxes, so not just on corporates, but on personal investments as well. So that is spooking the market to some extent. Look at what's happening with the Asian setup this morning, and we'll pull up Asian markets because the Nikkei definitely taking a hit. Now, why is Shanghai up? Shanghai, on the other hand, is up because look at the Chinese data which has come in. The manufacturing data has come in lower for the fifth month. It's contracted, but not as much as what was expected. So 49.8 on the PMI factory data for China. On the other hand, China continues its slew of measures to ease up the economy, to aid real estate. So I would say China and Japan dominate the narrative this morning, Niraj. And the implied open in India also looking weak as a result of what we're seeing overall. It's about 70 points down, so we'll see how resilient we are. But that's really the big story.
Yeah, I mean, China suddenly, for a nation which was not making any moves and doggedly doing some stuff, has suddenly woken up, and a slew of measures, one after the other, leading to metals going higher and half. So it's great for metal index, Tamanna, but you know, I fear for the end user industries in India, right? You have autos, you have real estate, etc. With metal prices doing what they're doing, and steel in particular as well, it could be negative news for those too. So That's to be kept in mind for sure. We'll get in a global guest in just moments from now to talk about all of this. But viewers, let me just try and lay out the trade setup any which ways while we just wait for that, because it's important to kind of keep this in focus while we are trying to talk about what could happen in India as well. And because what will happen globally will impact India. So there is a higher top, higher bottom formation for sure on the Nifty, and which is arguably positive. But I think we're now nearing overbought zones. Last week we were talking about how you should be careful with leverage longs, but not that you should take money off the table if you have positions. Now we are nearing the zones wherein the chances of a downside could actually increase. So please bear that in mind. There is technically a higher top, higher bottom formation, but we are close to overbought zones for sure. What stood out really in Friday's session was the kind of moves that we saw in the energy names. I mean, towards the close last couple of hours, the kind of moves that a HP, BP, IOC saw was quite stunning really. And Reliance is participating too. So in some sense, energy remains a key pocket that you want to watch out for from a tradable perspective, in addition to metals, because metals have this global flavor. Remember, on China measures, metals could be in focus. And for everybody wondering what could happen to metal stocks after the rally, already in Friday's session, CLSA came out with a note wherein they are saying that they expect upside for Vedanta, Tata Steel, Hindalco to the tune of the percentages on your screen. So therefore, maybe, just maybe, the metal rally is not over. And Tamanna, somebody just messaged me that is a large fund manager messaging me that they are subscribing to the Mire metal ETF that is closing today. So people who don't know how to play the metal rally could well subscribe to an ETF. Mire is one, but there could be others.
Yeah.
But subscribe to an ETF and you make money out of that.
Yeah, that commodity cycle becomes a very important story. What becomes important, I think, this month and this week is also flows.
Yes.
Niraj. So let's quickly just pull up what fund flows we saw on Friday and for the month of September, at least the provisional data we have. And that becomes important because on Friday you had foreign investors selling about 1,200 crores. Domestic investors bought in decent amount, 6,887 crores. That's a bigger amount than we've seen for a while. And if you look at the September number, now remember that 22,400 number, the 1,000 crore number for foreign investors is ex-IPO. So I'm not even adding in what has come in directly into the primary market. That number would be maybe upwards of 50,000 crores there. Domestic investors have also bought. So it's been a robust September. More IPOs down the line, and we'll speak about the one opening today. But meanwhile, let's shift focus to what's happening globally and get Seth R. Freeman on to speak with us. He's Managing Director at B. Riley Advisory Services. Seth, great to have you on as always. And, we're speaking on a day of so much action. So let's start with Japan. That's the big story this morning. And the assessment that the street seems to have made of the new Prime Minister and how much they would change. Seth, you're on mute, I think. I think Seth is figuring out how to unmute the Zoom link. Okay, we'll give that a second. We'll give that a second as we try and get Seth on. But yeah, I mean, I think what also amazes me, Niraj, is how immune the world has become to anything Israel is doing and the whole conflict in the Middle East. I mean, it just keeps escalating. The action that Benjamin Netanyahu has taken on the Hezbollah chief, and now saying that we're in a new phase of war, you still have a lot of inventory locked up, and it's making no difference. It's telling me how bad the demand situation
perception is for sure.
Yeah.
Let's ask Seth the same thing. Yeah, Seth Freeman, thanks so much for joining in. Great to have you. Can you hear us?
Yes, I can hear you. Sorry about the technical problem.
No, completely fine, Seth. I mean, that happens to the best of us. But just trying to understand, Seth, there are 2 or 3 big stories here. Let's start off with Japan and the surprise election outcome. Some people call it a surprise. What's the impact, Seth, of the same on monetary policy in Japan, the yen, and thereby any impact of the yen carry trade on other EM stocks?
Well, we've been seeing the decline of the carry trade opportunity over the last, 6 weeks or so. So this sort of thing is very positive for emerging markets. Long term, to the extent people were borrowing in Japan and investing in India, I don't know if that's really a thing. I don't know what the numbers are behind that. But, we're seeing a complete shift with what's happened from just, I was on with you a week ago, 10 days ago, after the U.S. rates went down, and some policy announcements like we saw in China, for example, it really made the market there rocket 22%. So policy changes in Japan are likely to have a much larger reaction than we would anticipate.
Just specifically, Seth, on what Mr. Ishiba is expected to do. And let me come to the Bank of Japan action. Last we heard Bank of Japan increases rates. This yen carry trade tsunami hits world markets, and then Bank of Japan and the then government comes in and says, okay, we're going to go slow. Is there a concern that with the new Prime Minister coming in, this stance gets reversed and we could see aggressive rate hikes? What would be the impact thereof?
Well, if there are aggressive rate hikes, that could be very disruptive to hedge funds who have very complex trades in place. But I would be really shocked. There are political and even cultural constraints on making major shifts within the Japanese market. So I would be pretty surprised if we're going to see major changes.
Okay, let's talk a bit about China, Seth. And what are the concerns as far as Chinese economy goes? The PMI now, factory data, has come in negative as was expected, but then a lot of moves being announced by China in quick succession. Is this giving some comfort?
Well, look what happened to the market in just a few days in China. It pulled in a tremendous amount of money, and suddenly investors, especially hedge funds and shorter term traders, are very excited about the Chinese market. However, the market's one thing. The tight control by the Politburo and the basic fundamental political shift risks, and especially the terrible real estate industry there, that doesn't go away overnight. So I think that this is really we're seeing movements based on pure opportunism, not necessarily long-term commitment.
Okay. Just trying to understand, Seth, in slight more detail, one question. There's a big rally building up in metals, right? So my question to you is, can there be further upsides to base commodities and industrial commodities because of what China has done? Or is the global growth overhang gonna hit those prices? Because crude is certainly not lifting off, even as base metals are. So what happens there?
Well, I think it really has to be more specific to which metals and the demand drivers for metals, as opposed to broadly, base. Yeah.
So which metals do you expect to rally, Seth? Let's put it that way.
Well, copper is still hot after being kind of in the doldrums, and zinc and some of these other metals that have been used a lot. Lithium is obviously not a base metal. For batteries, has subsided quite a bit. The issue in terms of some of these other base metals is related to infrastructure investment and construction and autos. So it kind of depends on how those particular industries are going to do.
Just one last point, Seth, and you spoke broadly about the impact of what could happen in China impacting all, or hitting all Asian markets, but the specific India view. What is the specific India view emerging at this point? Because it's being looked at for now some time vis-a-vis China. So even as China continues to contract, how do you think the flows are going to be and the view is going to be on India?
Well, I think those numbers you were showing for the aggregate numbers for September were pretty amazing. And what's most amazing that both domestic and international investors have to be observing is look at the number for domestic investors. 10 or 15 years ago, this didn't exist like this. and and money flows from foreign investors could just roil the Indian market. And the growth and the relative stability of domestic investors has completely changed Indian market dynamics. So yeah, you can see that fund flows were negative from foreign investors, but 4 times, 3.5, 4 times bigger by domestic investors. This didn't exist, and domestic investment is going to continue over the next decades. So for those reasons, I think that lower interest rates, continued problems in China are positive for India.
Okay, thank you so much, Seth R. Freeman there, talking about, what is the kind of impact we're going to be seeing. As far as India is concerned, well, the flows have been coming in and IPOs are moving them to a large extent. And don't forget that you have big IPOs set up for the next few days. But just to talk for a second about China, and we spoke briefly about iron ore prices, Niraj, and let's go through this as well, because look at what they have done over the weekend. 3 of the biggest Chinese cities have eased home buying curbs. Guangzhou has removed all restrictions on home buyers. Shanghai, Shenzhen have lowered their minimum down payment ratios for first and second homes to 15% and 20%. It's curbs being eased to bolster demand outlook for iron ore consumers. So a lot of moves, but like we were having this conversation on Friday as well with the ANZ global economist, more needs to be seen. And the problem with China is not just the number of curbs that have been put into place and few of them being lifted. The essential consumer demand is something that is truly worrying people right now.
But I think which is why this weekend, if what they've done for home buyers, and because home is such a big thing in China as it is in India, I think they've taken the first step to doing that. Now, more needs to be done. I think it's a difficult call to make which way the line moves from less to enough to more. But I think this is the first step that they have done. Let's see if there is more in store, because it certainly will have an impact on industrial commodities for sure.
Absolutely. And industrial commodities will be in focus today as well. Quick recap of what Friday looked like. We lost steam towards the end of trade, and you saw that pressure coming into the Nifty as well. Not massively, I would say, but yes, we did have a down day after a superb week, to be fair. You had pressure in realty stocks, private banks, so those were the spaces. BFSI was the space, the bank Nifty as well, being a bit of a laggard, almost 1% down on the Nifty private bank index. But let's pull up the bank Nifty, and you will see that you've had a bit of a tough time, 1% down here. But stocks to watch. Listen, the big story really today is the SEBI board meet. From our perspective, that is the biggest story. And for the first stock that I've put on my list, there are going to be 2 sets of impacts. First, I'm going with the positive. So we're talking about the BSE. The BSE has revised its fees. This is as per what the MCX did last week as well, and these are, SEBI regulations to make sure that you have equal fees. So in that sense, fees have been revised to 3,250 per crore. That's for the option trade. The BankX option trade fee has also been revised to 3,250 crores. So 2 ways of looking at it. I mean, you have higher fees coming in. Does it impact volumes is the second. And now the big cloud on the horizon, which we don't know yet, that if there are stringent measures to curb FNOs that comes in the SEBI board meet today, then that impacts the entire space. And Niraj will speak about it in more detail in just a second. So BSE is one to watch out for one way or the other. Bharat Electronics is the other one. So the Ministry of Corporate Affairs has approved an incorporation of BELIAI Aero Systems. Now, this is a joint venture between Bharat Electronics and the Israeli Defense Mechanism. So basically, Israel Aerospace Industries. BEL is about 40% of this JV, and definitely a big deal for the company as well. So Bharat Electronics, one to watch out for. Varun Beverages is the other one. Positive note from HSBC, so you might see a bit of an upside there. Set the target price at 780, so about a 24% upside from where it is right now. They say the bottling race in India is about to intensify. Disruptive digital market development models for driving sales coming to India with AI. They say Varun Beverages can become the largest and most disruptive PepsiCo bottler, and the company plans to add about 300 100 to 400,000 outlets per year to drive higher soft drink per capita consumption. Key risk, of course, is not keeping pace with the leaders' new requisite market development tools and culture. But Varun Beverages is definitely one big positive today.
Yep. On my list, you could actually pencil in a clutch of pharma names, from a Lupin to a Jubilant Pharma Nova to a Biocon. I've just chosen Biocon. The Lupin is as important because Pithampur facility is a big one from a US supplies perspective. So you reckon that Lupin could correct as well in the session today. But yeah, play with Biocon, for example. So Lupin has an important one, but let's play Biocon. So US FDA inspection at the Bengaluru API facility ended with 4 observations. The company said that this will not have material impact on its ops. The problem for Biocon is that it's not just this. There is also the Biocon Biologics facility at Johor Bahru, Malaysia, which has ended with Form 483. Now, the implications of this, in moments from now, Varsha will join in and tell about all of these pharma names. But keep an eye out. I'm just saying that some of these pharma names will correct, or very likely correct. So that's the first set of names on my list. The iron ore price uptick beneficiaries. Tamanna highlighted the reasons why, what are the steps that China has taken, and the result of which iron ore prices or iron ore futures are up 10% this morning. Remember, over the weekend, base commodities were soft, but iron ore prices futures have surged. So NMDC and Lloyds Metal could well be key beneficiaries in this session. Now remember, Lloyds Metal, since the time it did the QIP, has had a massive move. I mean, the last 1 month, it's been a rank performer. This is intraday on Friday, but the 1 month performance for Lloyds Metal has been stunning. The question is, can it do more? Some people say it very well can. The other bit is exchanges reducing the transaction fees and the impact that it has on on the EBIT of some of the brokerages. Because remember, brokers, more volumes, they have to pay less to the exchanges. The customer has to pay the same fee, so therefore it got all added to the EBIT. Now that might have a bit of an impact. So the high volume brokerages might certainly have a bit of an impact in the session today. So watch out for Angel One, watch out for 5 Paisa, watch out for IFL Securities, ICICI Securities. All of these could have a material impact in the session today. So those are the first 3. Before we talk about some of the others, Tamanna, anything else on your list?
I just wanted to add the IPO listing, because frankly, that's the hottest thing in the market right now. And how can you forget Manba? You are the one who has been so excited about
224 times, yeah?
Those insane subscription figures. So 224 times subscribed. Manba, which is basically a finance company for 2 and 3 wheelers that lists today. Price band was 114 to 120. I mean, your grey market prices and those estimates keep changing. But suffice to say, with that kind of a heavy subscription, you could see a decent listing for Manba. So one to watch out for. Yeah.
And just a couple of infrastructure names before you move to pharma. Mind you, it's also some very interesting notices put up by the companies. So Welspun Enterprises, Tamanna, declared an L1 bidder by BMC for a project worth 1990 crores. And therefore, you would probably expect a reaction on this one. And you probably expect a reaction on PNC Infratech, because they've approved the sale of the assets and undertakings of a company. The approximate aggregate enterprise value of all of the target SPVs is about 9,005 crores. They get a sum of it, of course, but because they've taken this step, very likely that the stock could react. So a couple of infra names as well in focus today.
Yeah, so infra in focus, so is pharma, and pharma for a whole host of reasons. Varsha is joining us with the details on Biocon, Lupin and more. A lot of them have had visits from the US FDA and the outcomes are now known, Varsha.
Yes, Tamanna. So outcomes are negative for a few of the pharma companies. Let's start with Biocon, wherein the US FDA completes inspection at Biocon Biologics insulin facility, which is in Malaysia, ended with 8 observations, and there was other inspection also for their API facility, which is at Bangalore, which ended with 4 observations. So in total, negative for Biocon. Then we have Lupin, wherein US FDA inspection ends with 3 observations each on API and finished product side. Now this inspection was held at Pithampur Unit 1 facility, which is for API and manufacturing facility, and this inspection was held from September 16 and to 27. Now Pithampur facility is actually important for US supplies as it manufactures oral solids and ophthalmic dosage forms. Then we have Jubilant Pharma, big negative for the company, wherein US FDA determines inspection classification of its arm JHSGP's Montreal facility, which is in Canada, as OAI. OAI. Now, OAI stands for Official Action Indicated, which means that this is the strictest regulatory classification, and it means that the regulator issued observation to the plant and was not satisfied with the response by the company to the observations. Plants with OAIs are generally required to be re-inspected by the US FDA officials to give it an all clear. So big negative for the company. And there are a few positive news for the pharma companies as well, starting with Piramal Pharma, wherein US FDA inspection for their Ahmedabad manufacturing facility ended with 0 observation. Zydus Life Sciences has got final approval for a product which is used to treat prostate cancer, and the estimated annual sales stands around $869 million US. And also Zydus and Central Drug Research Institute Lucknow will develop a product or a drug which is used for chronic kidney disease. And lastly, we have Alembic Pharma, again a positive news for the company, where they've received approval for a drug which is used to treat schizophrenia.
So Varsha, there are 4 or 5 names out there, right? Which is the one which is likely to see the highest impact? Varsha, can you hear me?
No.
Okay, I think we've got an audio glitch there. Varsha's EP is probably off. Okay, Varsha, you can hear me. Tell me.
I would say for Zydus, yes, it's a big positive for the company because of the estimated sales that we have got. For Alembic Pharma, we don't have the estimated sales in the US.
Okay. Well, trust Varsha to see the green shoot in an otherwise dark day for pharmaceuticals, but Zydus on the positive side, some of the others might well have a bit of an impact, so that's to be kept in mind. Okay, there's the big development today evening could well be the outcome of the SEBI board meet. So the meeting is today, and Agam joins us to tell us about the expected measures the regulator is planning to take to tightening trading in the derivative space. Well, Agam, it's never known until it's known, but what are the probabilities?
Right, so we'll go back about a couple of months ago where the SEBI did put out a paper in which it has made 7 proposals when it comes to the futures and options space. Some of them are perhaps easier to implement, and it certainly is a big positive because it will add that much more of a risk management to the system. Well, among them, of course, so we are talking about rationalization of option strikes, which means that we will have option strikes which will be available, which had a little bit more liquid, and the elimination of relatively lesser liquid option strikes so that you have more traction closer to the at-the-money calls and puts. Moving on, we have upfront collection for option premiums, and this includes those for buyers as well. It's of course very valid for option sellers, but even in terms of buying now, option sellers or option buyers would potentially lead to will have to place the money with the brokers before they in fact go ahead and place those bets. Moving on, there's also removal of calendar spreads, and this is in order to curtail the leverage that a lot of traders take. There's been a lot of traction with respect to weekly expiries because we have nearly one expiry every single day. There's been increased speculative traction, and because of that, there is a measure where there could potentially be a reduction, or as well the paper puts it, rationalization of your weekly options expiry, and that perhaps could be the biggest of the measures that we could potentially see coming through. Again, it's a wait and watch as to what the board meet can throw up for us, but moreover there'll also be this aspect of increase in margins for the near-term contract. Now this of course perhaps is valid and on expected lines, because we do need to see a reduction in the permissible leverage that a lot of traders can take as far as this options markets are concerned. All in all, majority of these issues and proposals that the SEBI is looking to take, or rather considering at the moment, will certainly strengthen the risk management system and curtail systemic risk when it comes to trading in the futures and options space. There is perhaps only one which stands out, and that is rationalization of weekly options. That's where there could be a significant impact on exchanges as well as brokerages. And by that I mean, when you in fact see just maybe 1 or 2 weekly options expiries instead of having option expiries on every single day of the week, well, we will see a reduction in brokerage for a lot of these brokerage companies, and the exchanges will also, that means, will have to bear that hit as far as revenues are concerned. Don't forget that a bulk of the revenues, the bulk of the revenue growth that BSE has seen of late, and in fact we've seen such strong growth in revenues for the last 2 quarters, a lot of that is also on account of the weekly options expiries that they have introduced very, very recently, or rather reintroduced. I'm just going to, and because of that, of course, we will have the likes of BSE, Angel One, IIFL Securities, 5paisa.com, a lot of these discount brokerages which will be in focus. Even besides that, we have something like a Share India or ICICI Securities, which potentially could see some sort of an impact should we see that traction come in. So plenty to keep an eye on as far as the SEBI board meeting is concerned today.
Yeah, absolutely, Agam. I mean, imagine a Nitin Kamath, Zerodha, of course, in the unlisted space, but a huge player, comes and says that he expects a 10% hit of about 3,000 crore rupees if these rules are tightened. So that's, of course, one part of the story. But with the entire capital market space, 2 things happening today. The other is that exchanges have announced a revision of tariff in line with true-to-label regulations from October 1st. Now, what does that mean, true-to-label regulations? That tariff increase, is it good for exchanges? Does it hit volumes for brokerages? Sajid coming in with more on that. Yes, Sajid.
That's right. The true-to-label charges or tariffs are going to come into effect from October 1st. Both the exchanges, NSE and BSE, have reduced the charges, and they've taken it to the lower band which is there. To give a perspective, the earlier charges were tier-based, which basically means the more the revenue which was done by the broker, the lower the tariff which was which was supposed to be paid, and they used to pay on a consolidated turnover basis. While the clients or the investors used to pay on a trade basis, which is there. Now, if you look at the tariffs which have been brought into play, the cash NSE has brought down the prices in cash and equity futures to the lower end of the band, but the options prices are much higher. The same is the case with the BSE, where the cash and equity futures tariffs are constant, but option prices have gone up by nearly 10%. So there is still a room of nearly 8 to 9% for BSE to raise prices to match NSE. But what brokerages are talking about is the earnings are going to be, it's going to be a positive for earnings for both the exchanges, given the fact that on the whole, as the turnover remains, the earnings are going to be positive in NSE and BSE. But this does not take into factor the SEBI board meeting, which is going to come in and bring in more tighter norms for trading in F&O for the investors there, because SEBI is expected to bring in tighter norms which will increase the total the cost and the sizes of options trading in the market for retail investors, and that's going to have some kind of impact on the volumes, and that needs to be seen how it's going to come in. So while exchanges have announced the tariffs from October 1st, brokerages are yet to respond. Maybe they're waiting for SEBI's announcement before they can come out with the comprehensive new tariffs. But one thing is for sure, that tariffs are going to go up, or the trading charges are going to go up for the retail investors going forward. The biggest impact would be for some of the brokers, where the impact will be on the top line and on EBIT level, because the buffer they used to get because of the tiered turnover charges which exchanges used to offer to the brokers, now has gone away, and basically now it's a pass-through of charges from the exchange to the broker to the clients, and so there is no incentive or the buffer which is available for the brokers going forward.
Okay, so discount brokers in focus today, exchanges in focus today. Thank you so much for that, Sajid, for adding all of that perspective. But let's talk about what the F&O space is looking like today. And back to you, Agam, on what is Monday seeming like?
So last week was a week where we saw the Nifty and the Bank Nifty hit new lifetime highs. A lot of traction towards the long side. We also saw strong rollovers come through towards the long side. And it does seem like this week could potentially be about consolidation. Now, we've seen about 1.5% increase in open interest, even as we saw a little bit of moderation in the Nifty spot. The Bank Nifty was down around 1%, but that is where we saw unwinding to the tune of 3%. As we move into trade this week, in terms of the levels being watched based on options, where 26,000 puts still have a lot of open interest at the moment, and that perhaps could be a near-term base. On the higher end, we continue to keep an eye on 26,500 because there's been a good amount of call writing there. But moving on in terms of stocks as well, it was a mixed day rather, and we saw granules in Colgate, which saw but longs coming through, but shorts for Marico, LTIM, and Birlasoft. LTIM surprisingly because it moves into, or rather moves out of the Nifty 50, and we saw about a short covering for Gale, Syngene International, REC, Atul, as well as Canara Bank. So plenty of these counters which remain in focus today as well. But let's take this forward and ask an expert as to what he makes of the market. We have Ajit Ramya of Ajira Ventures who's joining us on the show. Ajit, good morning. Thank you so much for joining in. Ajit, I was looking at your Bank Nifty strategy. I wanted your opinion on this one and why you're deploying the kind of option structure that you're using at the moment. If you could also explain what you're doing here.
We find Bank Nifty a bit weaker than Nifty, looking at the past data. So we are a bit bearish on Bank Nifty. So we a bit bearish, and we have a weekly expiry tomorrow, as Wednesday is a holiday. So we have 2 days for this expiry. So we deploy a bearish butterfly strategy, where this is on the weekly basis, where we buy 153,800 put at 179, thereby sell 253,600 put at 117, and hedge it with buying 153,400 put at 77. So the total investment or the maximum loss in this strategy is mere 22 rupees for a possible gain of around 200 rupees.
All right. Well, of course, based on the structure, you stand to make the most at around the Bank Nifty at around 53,600 should that come through. And do remember that we've lost out on 54,000, so it's something to bear in mind because now 54,000 becomes a little bit of a resistance zone now that we've closed below that. But moving on, I believe sugar stocks, of course, which have been focused as well last week. Ajit, you have one of those on your radar as well this morning.
So stock is chilling, and we are bullish on this counter as the shoe prices are gaining in the international and the domestic markets. This is giving a good breakout in the sugar sector. So we recommend a bullish spread where we buy one ATM call of 660 of this expiry at 2680 and sell one out of the money call of 700 at 30 rupees 10 paise. So the net investment of this trade is around 13 rupees to gain a potential of 27 rupees. So 700 being our target price and 660, which is the current price, being the entry price.
Ajit, just a quick question. Why is it that you're playing a bull call spread, and why is it that you're not buying a call straight up for Balrampur Chini if you are bullish?
Just to reduce the cost of our investment. So we keep very little money on the table. So the amount of money kept on the table is mere 13 rupees. Instead of that 27 rupees for 660 calls. And our target is 700, so makes sense.
Okay, fair enough, Ajit. We'll leave it at that. Thank you so much for joining us and taking us through your view on the Bank Nifty as well as Balrampur Chini. Well, two option structures given to us by Ajit, where we're expecting a little bit of a decline as far as the Bank Nifty is concerned, and coming down to Balrampur Chini, expecting a lot more strength based on the technical parameters that Ajit Ramya has spoken to us about. With that, it's back to you all.
Okay, thank you so much, Agam, and obviously that's going to be the big focus. I don't know, the whole thing with the F&O trade, Niraj, and the kind of regulations that we're expecting from SEBI. Board meeting at 5, ends at 5 today, so watch out for that on NDTV Profit and of course tomorrow morning, is is there going to actually be that extent of a crackdown, or more of let's go step by step? Because clearly, if 90% of your volumes are coming from this space, you don't want to come and clamp it down completely, even as concerns are increasing over what happens to retail investors.
I mean, a safe assumption, Tamanna, you're right, that it will be a measured way. Sure, the end result may be very different 2 years out or 1 year out, or however you look at it. And so much talk of how the 5 expiries were brought in to create volumes. Now that volumes have been created, can you move back to a single expiry? I mean, who knows how it happens? Does it happen in a gradual fashion? Does it not happen? But some measure for sure. I mean, there's so much of, as you've been saying, it's not just an economics move anymore per se, or just a stock
very
market
political.
loss. Exactly.
Very political. You have now politicians coming in and saying that, you know, investors are losing money and they don't understand what they're doing, which is a fact. I mean, we spoke to investors as well. A lot of them are not really understanding what's happening. So that's going to be one concern. All right. So, of course, those set of companies on our watch list this morning. But what else is there that you should watch out for? Let's look at Nuvama. Nuvama is going to be in focus today because, remember, their blocks have been absorbed. Basically, sales in their equity shares have been absorbed by some heavyweights. So Morgan Stanley, Goldman Sachs, the small cap world fund, all of them have bought into Nuvama. So expect a bump up over there today. NMDC and Lloyds in focus because remember, we're speaking about iron ore, impact of China's moves to open up their market to ease pressure, and iron ore futures have spiked 6-8%, over 10% actually today, and 24% in the last week. So expect these two to react. Tata Motors is the other one. They will be investing 9,000 crores in a greenfield manufacturing facility. They actually had the breakdown over the weekend, as a groundbreaking ceremony over the weekend.
Yeah, it's not 9 crores, it's 9,000 crores, but be that as it may, Tamanna laid out the impact thereof. Welspun Enterprises could be interesting, has won a 1,990 crore BMC project, so could be active for the stock. Varun Beverages is interesting. HSBC initiates coverage. More importantly, the target price on that is higher by 24%. NTPC is interesting too because Jeffries says that the value unlocking could add to 5 to 11% to their target price. So keep an eye out for all of these.
Okay. Pharma in focus. It's going to be a down day for pharma companies because of a host of action which has come in Biocon. They've got US FDA observations for 2 units. Jubilant Pharm gets an OAI for their Montreal facility. Lupin also sees 6 observations in their Pithampur unit. So it's all about US FDA and negative sort of observations, which is going to dominate at least a few of the pharma pack today. All right, let's start with the conversations for the day. Soni Patnaik of JM Financial Services with us on the show. Kush Bora of kushbora.com joins us in studio this Monday morning. Welcome to both of you and great to speak with you as always. Kush, let's begin. I mean, we've had a breathtaking week last week, upside surprises, positives going through. Are you seeing that kind of momentum continue on the indices?
Sure. Taman, today I won't start with the usual good morning. I'll probably start with a happy Diwali or a happy Dussehra or a happy Navratri.
Already.
Take your pick because that's what the markets are celebrating. I mean, markets are already in that zone, aren't they? Right? No, I think, somewhere this party has to stop. But then who are, you and I, who are we to say that, where and when does it stop? So, as, Niraj and I discussed, I think on Friday, is that the only trade in town is to stay long. Now, as far as the momentum is concerned, we know that's very much there. We know it's a little overstretched, but we aren't seeing any negative divergences just yet. So what we'll do is we'll continue staying long. So if you've got a long position with a positional stop loss of, let's say, 25,900, 26,000 thereabouts on the Nifty, you continue to stay long. The other question is, if you don't have a long, then what do you do? Like we said last week, how do you play a mid-cap stock that is very high on momentum but already overstretched? You still play it for the momentum but with limited quantity. So what you do is you don't go out and buy, let's say, the entire worth of 10 rupees, you buy maybe 20, maybe 50, not more. Because if the tide were to turn, and when the tide were to turn, the risk management systems aren't really going to protect you in a big way. So you continue to stay long on the Nifty, but if you're taking a fresh position, you go a little light on the quantity. But as I said, the only trade in town is on the long side.
only trade in town is on the long side. Do you agree, Soni? And what would that trade look like?
Hi, good morning, Tamanna. Good morning, Niraj and Kush as well. Thank you for having me on the show. So I think, I see markets as a bit overheated, and there's no wrong if a correction were to come in a day or two, and the correction could lead the Nifty up to 25,800 odd levels. I think it's wise just to stay hedged when it comes to indices positions, maybe stick to stock specific position as well. And whenever you see the indices, either Nifty or Bank Nifty towards its support around 25,800, and for Bank Nifty, the support is around 53,300. So I think these support levels are going to act quite imperative for October series, and look for a buy only on those support levels. For the day, if we're seeing that the GIFT Nifty is indicating a slight gap down opening, there could be a follow-up profit booking during the day. So maybe avoid a buy on indices for the day and just wait for the indices to reach the support level and see a turnaround from those levels. As of for now, the strategy would be to stay hedged when it comes to indices, or probably stick to stock specific strategies.
Okay. What about stocks, though, is the key question, right? So, Soni, can I ask you what your recommendations are for the day today? Good morning.
Good morning. So the first would be from the Pharma pack, Zydus Life, which has seen a good support reversal taking place around 1,050 odd levels, and it is heading to test its 20 EMA hurdle around 1,100 odd levels. So Zydus Life anywhere towards 1,070 one can buy, keep a small stop loss of 1,060, and a target of 1,100 to 1,120 can be seen. The second pick comes from the OMC basket, which has seen very strong fresh longs adding in the last week, and the stock is IOC. It has also given a good breakout on intraday chart, so one can buy IOC from 181 in the range of till 180, and keeping a stop loss of 177, and a target of 190 can be seen in the coming days.
Friday was such a big buzzing day for oil marketing companies. This doesn't come as a surprise. It's IOC. I mean, it could well have been BPCL, could well have been HPCL, could well have been IOC. Sony's chosen IOC. All three doing just so well. Kush Bora, what about your stock ideas for the day today?
Sure, Niraj, first up, good morning.
Very good.
Just a quick word on Bank Nifty. I think this consolidation that we saw on Friday is healthy. A lot of private banking names that had run up have seen some profit booking. But what is heartening to see is that there is a change of leadership, if I can call it that, maybe a little too early, but the PSU banks were doing well, and we've got a good put base at 53,000, and the OI additions also piling up, which suggests that the investors are still bullish on Bank Nifty. So any kind of dip should be taken as a buying opportunity on the Bank Nifty. So 53,300 is the positional stop loss on that one, and you play for targets of 54,400 and 54,800. So that's a quick word on Bank Nifty. As far as stocks go, I think consumption is the theme. Right, not a big fan of FMCG just yet, but the overall consumption theme has been doing well. So Colgate is a stock that we discussed on Friday, and incidentally, a stock like Colgate went on and hit a 2.5% target one. So I think that's one play that can continue for a target of 3,900. For the day, my picks are Pidilite and Tata Technologies. Again, similar story. If you see, Pidilite has been having a good move. Friday, we saw a clear breakout above that 3330 kind of resistance zone on the back of very strong volumes. For the near term, 3450, 3540 are the targets to play for. 3280 is where you place your stop loss. The other stock is Tata Technologies. Fairly recent listing, but you're seeing early signs of a turnaround on that one. The base is already there in place around the 950,000 mark, and now you're seeing a pickup in volumes and a turnaround in the price action as well. So if you're playing this from a near-term perspective, then you're looking at a 1160, 1200 kind of a level on the upside, and 1080 is where you place your stop loss.
Any view on Varun Beverages, since you spoke about consumption and there's a buy call from HSBC today?
So I think this would perhaps fall in the Trent category, except that this one's already had a round of profit booking. Trent hasn't seen anything of that sort, correct? The stock's actually done quite well. In the recent past, it's seen consolidation. I think with the kind of news flow that's come about and also the consolidation that is going on, this makes a good buy. The momentum is missing, so you might not get really like a very big upside on a very, in a very short span of time. But if you're looking at a medium-term kind of a perspective, then this is a very good entry point, because the support zone for this one comes in at about 600. On the upside, you're looking at 680 and higher kind of levels. So the risk-reward ratio is also getting favorable. As I said, the momentum is missing. Perhaps the news could act as a kicker, but you could still play this for the momentum, for the medium term. from a strong risk-reward perspective.
Okay, Avinash, very good morning. Great to have you on the show. First thing I want to ask you is about BSE and the capital market play. Are you seeing any nervousness or impact in this segment of companies? Because we'll have to wait and see till this evening what SEBI actually says. But if there is a tightening in F&O regulations, as is widely expected, what is the impact you see?
Yeah, good morning, Tamanna. I think, it could be a knee-jerk reaction, but I think longer term, I don't think that these measures are going to, impact the F&O volume quite significantly. I think the appetite in the market is extremely strong, and I think it could create a little bit of nervousness in the short term. But in the medium term, I think things could get neutralized, and I think F&O trading is not about restrictions. I think as long as traders have the risk appetite and they can confidently make money, I think F&O volumes are unlikely to get significantly impacted over the medium to long term. So I think maybe in the very near term, once these rules get into effect, I think from October onwards, you could see a knee-jerk correction initially, but I think that is not going to spoil the mood. I think, the trading mentality and the trading sentiment continues to be quite robust. We have been talking to large traders, and I think everybody is mentally prepared for this. So I think it's not something which traders are, expecting as a big negative surprise without any intimation or, information. So I think it's going to be a gradual process. I think, as you rightly mentioned in the early part of the interview, that the government will also not like that the F&O market is squashed in one single shot. So I think it would be a progressive way to ensure that the process is followed properly by all the market participants.
Okay, just one big call for the day. How are you feeling about the Pharma pack today? Are you expecting a lot of volatility there, Avinash?
Yeah, I think, volatility would continue, but I think, there are pockets of opportunity. And I think we have been telling our clients that stock-specific approach is the right approach, when you look at pharma companies. So I think we have been bullish on larger names like Biocon or typically something like Sun Pharma. I think clearly companies which are well positioned in the US market and which don't have any regulatory issues. I think any dip in the market, considering, the kind of scenario we are seeing, should be used as an opportunity to accumulate. I think the pharma story is not yet over, Tamanna. We could see better earning numbers coming out, post the Q2 numbers. And once the Q2 result season starts, I think all of us would be focusing on the earnings numbers. So I think Biocon, Sun Pharma are stocks where we feel that any correction could be used as a good entry point.
Okay. All right. We'll take a very short break. We're right back with pre-open rates and more. Stay tuned for the top calls of the day.
Back with India Market Open right here on NDTV Profit. Now, Zen Technologies has launched remote control weapon and surveillance systems for domestic and global markets. It's 4 advanced solutions across land, sea and air. I tell you, they keep on doing a thing or two to make us invite Ashok Atluri, the CMD of the company, to try and understand what next is in store after the fabulous guidances that they've already given. Mr. Atluri, great having you. Thanks for joining in. Good morning. Please tell us a bit about the importance of this.
So, I think, we had 2 categories that we were always focused on, was simulator and anti-drone system. And now anti-drone system actually requires some kind of, to bring down the drone, they require some kind of a hard kill system. So the camera and the, remote control weapon station to manipulate the weapon was required. To carry and automatically target the thing was required. So when we developed this, we saw that a slew of other products, other cameras, like, for the tank, for the, the rugged camera for the artillery, can also be made with the talent and the technology that our associate company already had. And in addition, we have also got this RCWS for 7.62 for the tank, remote control weapon station. Typically there are soldiers who are manning these things, and they're always at the harm's way, especially with the drone threat coming now. So these remote control weapon stations will be able to take the soldier out of the harm's way. And of course, all the systems, while being fully integrable with anti-drone systems, are also independent sources for which can be deployed on tanks, on naval defense ships, etc.
So, Mr. Atluri, what's the TAM or a total addressable market that you see for something like this? It sounds very, very interesting, but what's the TAM like?
So, actually, again, Niraj, we are working on the TAM side. It's running into thousands of crores, but the exact figure, we are interacting with the customers and, trying to find out what is the TAM and, what is the timeline in which they plan to acquire. So this is, I think an interesting opportunity for us, even though it is, very, very adjacent to our core anti-drone system, but this is becoming its own line, which is very, very encouraging for us.
Mr. Atluri, good morning. It sounds exciting and really cutting-edge technological solution there that you have launched. Who is this for? Is there already sort of a customer base which has been locked in, orders which have come in? And what is the potential size of orders that you could get? I mean, of course, you spoke about an addressable market which is into thousands of crores, but drilling down, when you launch a new line of products, who is this for?
So this is for the army, infantry, artillery, and armored corps. All these within the army, and of course, even in the case of navy, we are saying the ships can mount these and remote control weapon stations, and these and the weapons can be mounted on them. So
what I mean is there an understanding, say, with the Indian Defence Forces for this, or are you talking to? I mean, is there a customer base which has already been identified?
Yeah. Customer base is completely identified. These are I was talking about the army, the corps that are interested, and the naval ships on which it will be done, where it will be done. To your question, whether, is there any guaranteed orders on which we are depending? All throughout we have, identified the need and, didn't potentially, map the market in a very, very broad manner and decided that, if this is an important thing. And again, it aligns completely with our view of, how do we take a soldier out of the harm's way and remotely control it, with the remote technology. So given this, we feel that the necessity of the product is there. And again, we expect, to your question, when will the orders start coming? We expect the next year will be the time when we'll start getting orders in this. And we have actually recently that it was tested in very high altitude, also trial tested in high altitude. And we think that now we are ready for, start selling. So, but the revenues, the earliest we think in next year we'll get recognition on the sales of these.
So just to clarify, no guaranteed orders right now, but you do expect orders and revenues to come in from next year?
Absolutely, you're absolutely right.
Okay,
yeah.
And in fact, that's what you have told us in the past as well. For a lot of new innovations that you have launched, the new products, revenue stream comes online next year onwards. Do we have any visibility of speed and pace of these revenues coming in for next year?
So again, based on our interactions with the armed forces, they are saying, listen, this is the need of the hour, and we will be buying these products without any say. Again, we were not able to put a figure on that exactly.
Just let me ask you a question about exports. You had no export revenue last quarter. This is, of course, in line with your targets to maintain about a 30-40% mix. Are you seeing a pickup there in exports, or what is the scenario there?
Yeah, we will this year we'll be having good amount of export revenues as project in our breakup. We expect that, yeah.
What is the size of the export revenue that you're expecting?
So, out of the 1150 crores order book that we have, almost 400 plus crores are export revenues. So I think probably, in that proportion we'll execute during the year also, maybe about 300 crores or so.
Mr. Atluri, one final question from mine at least. You talk about these patents that you have, you coming out with these products on which they are new and therefore sure the TAM can be predicted, but it's a large one. What else can be anticipated? Because this is something that came out of the blue. Not too many people anticipated you do a product like this. Are there more such products in the pipeline wherein the revenues could be, or rather the addressable market could be very large over a period of time? Anything in the annual in the current financial year?
So no, I don't think that any big announcement of the products will be happening. But again, organically, we are improving our simulators to the absolutely next level with better technologies. And anti-drone system, it's a never-ending evolving product. So we expect a lot of upgradations happening in that. But in this segment, I think the new announcements may not come anymore immediately in the near future.
Okay. Mr. Atluri, we'll leave it at that. Thanks so much for taking the time out and speaking to us, and all the best with this and more.
Thank you.
All right. Avinash Gorakhshekar, you heard the management. You've seen what the business has done. The guidance is strong. Any thoughts on Zen Tech? Valuations certainly not cheap.
No, I think Niraj, valuations are not cheap, but I think the key moat in the business is obviously product innovation and R&D. And I think in that aspect, Zen is preparing the ground for the next 2 to 3 years. The defense opportunity is a very large opportunity, and within the drone opportunity, Zen is a very dominant player. It already has a very healthy order book. So my sense is, I think this is not a company for a short-term period. Somebody who's got a 2-year kind of plus horizon can obviously look at buying the stock, in SIP and gradually accumulate it. Because once the order win is announced, I think you could see a runaway rise in the stock again. So I think clearly a very strong, company with a very strong management kind of team, and R&D is going to be their plus point. So I think, it's always advisable to buy such stocks for a longer time frame, but, on dips, because at these valuations, as you rightly mentioned, valuations definitely don't appear to be cheap. They are expensive, but I think the next 2 to 3 years could be a big opportunity for the company.
Okay, so Zen Tech, in the next 2 to 3 years, I mean, the exciting bit is how they talk about a lot of their innovative products coming online as part of their revenue stream from next year. So are you seeing another re-rating next year coming in or not is the question. Okay, Sony, but I want to come to you on, some of the metal names, and are you liking any of them? Let's talk about Lloyds. Let's talk about some of those names that are going to get impacted by the iron ore bump up. And in that space, what are you liking this morning?
So Tamanna, not a lot from the space. I feel that, it has already run up quite a lot, and there could be a bout of a profit booking seen for the day or two. However, a stock which is given a very strong rollover would be JSW Steel, and one can look for it on any sort of a, declines towards 980 odd levels. It has shown strong long side rollovers for October series. The stock has also given a good breakout. So any closer to 980 as a support can be seen as a good bounce back level. One can initiate a buy on those declines. The stock has the strength to test 1040 to 1050 odd levels in October series.
JSW Steel on target. Another company that has really been in focus is PB Fintech. First, for a foray into the healthcare space, and then for a clarification that there is nothing planned on it right now. So what really is the picture emerging? Yashish Dahiya, Chairman and CEO PB Fintech, joins us now on the show. Mr. Dahiya, very good morning and great to have you on NDTV Profit. Thank you so much for taking out the time and speaking with us. So let me start by asking that conceptually, the idea seems to make sense that if you are selling health insurance, why not complete the chain and make it easier for people to access the end product as well? But how exactly do you aim to fulfill that need?
Yeah, I think let's call this a company XYZ, and PB Fintech is at some point going to go to its board and request for permission to take between 20 to 35% stake in this company XYZ. But it's important to understand what is XYZ doing and what is PB Fintech's interest in XYZ, right? So there are about 4 crore people in India who pay about 10,000 rupees every year on average to buy health insurance. And at the point of claim, they have a difficult time sometimes. And they have the reason for this difficulty is a lack of conflict, is a conflict of interest between hospitals and insurers at that point. For one, it's a revenue, for another, it's a cost. And also, ARPOPs have been increasing very fast. So the healthcare cost is really rising very fast. And the middle class India is struggling to keep up with it. And the insurance industry is also struggling to keep up with it. So the idea is to create an HMO. XYZ wants to create an HMO for the insurance industry and wants to pilot it in NCR by acquiring 6 to 8 hospitals and making sure and demonstrating that cost of claims can come down while giving good quality customer experience. As far as the customer is concerned, the idea is to make sure that something like bill and claim goes out of the customer's vocabulary. Because today, the customer has a lot of anxiety about what will the bill amount be, how much will be approved, how much will not be approved, how much is going to be settled by the claim, and then how much will I have to pay out of pocket. The idea is to make that experience seamless while still reducing cost for the customer. And also investing a lot more in care and wellness so that customers largely stay out of hospitals. See, think of a very simple thing. If dengue breaks out in Delhi, that's a cost for the insurance industry, there's a revenue for the hospitals. So to some extent, we're trying to align both of them, as in XYZ is trying to align both of them. Now, PB Fintech wants to take a minority share in this for 2 reasons. One, XYZ benefits a lot because of the existence of PB Fintech, because PB Fintech can explain this to hundreds of thousands of customers every day that, look, this is a great idea, you should try and take a product like this because it's beneficial for you, and thus popularize the concept. So to an extent, XYZ benefits because of that, because it gets scale because of that. And I think for PB Fintech, it's a huge advantage.
Yeah, can I just come in with one specific point on XYZ? And I must say, as someone who has been on that other side of claims and bills, and I'm sure a lot of our viewers connect with this, it's great if there is a seamless experience. I'm just trying to understand that for XYZ and the hospitals that they own or acquire, it doesn't make sense to reduce hospital bills. It
does, and I'll explain why.
Yeah, so how do you run a hospital business with lesser bills?
HMO is not a new concept. HMOs exist all over the world. These are dedicated facilities. So this is a dedicated facility for the insurance industry. And thus all their processes, all their procedures, everything aligns and has got a huge amount of trust from the insurance industry. I'll give you a very simple example. Take 2 cities. Both have 10 million people. In one city, all the customers pay upfront and say, healthcare costs you have to take care of. The other city, everybody says, no, you don't take care of anything. I will pay when I fall sick. Now just think of a very simple thing. In city A, the hospital actually benefits if nobody falls sick because they've already been paid. In city B, the hospital benefits when people fall sick. Financially, I'm not trying to say anything more than that. But financially, there's a benefit because that's when hospitalization happens. So one actually benefits from higher utilization. One actually benefits from lower utilization. You are turning the entire, it's like I have already been paid. Now every service I am providing is from my own pocket. So actually my interest is in the service. And now you just think of it mentally between city A and city B. Which one will be able to serve a larger population with a smaller number of rooms? My bet is city A will be able to service it because city A has a defined interest in making sure people do not fall sick, do not end up in hospital. There is home care, there is strong OPD, there is strong wellness. Whereas in city B, the interest is I will make money when people come to me. So at least from financial interest perspective, City A will handle more customers per room than City B.
Sure.
And I think if one appreciates that, I think that is the real answer here.
Got it. Yashish, good morning. If this goes through, wishing you all the best for that. My question is from a PB Fintech shareholder's perspective. How much does the shareholder see PB Fintech investing in this? Because you have about 5,000 crores of cash, if I'm not wrong, in or about. So, and would the ROIs, simply put, I'm just using ROI as a metric, would the ROIs on that business be commensurate or better than what PB Fintech enjoys currently?
No, absolutely. So see, this is, first of all, it's an investment. It is not PB Fintech owning hospitals. The investment will be between $0 to $100 million. It's a one-time investment. There is no commitment to keep on investing into the future. This company XYZ will, in a good case scenario, prove this model works and then either do an IPO or go into a REIT infrastructure kind of arrangement. But it is not PB Fintech's job to make sure that the next phase of its growth is funded by PB Fintech, right? So I think from PB Fintech shareholders' perspective, the total potential loss is the investment. Also, a bulk of this investment is going to real estate. I don't think real estate is going to go down to zero. Even if the venture fails, you will get something back out of it. So I'm just trying to, really talk small here. But at some level, there's a lot of defensibility in XYZ's, cost infrastructure is largely real estate cost infrastructure. Finally, the reason we believe in this is because it has a huge benefit to PB Fintech if this works, because the insurance industry grows. And so I think you cannot just look at the downside, you will also look at the positive side. That maybe PB Fintech's business, if it was going to be X over 10 years, could be 3X. And the insurance industry, if it will be Y over 10 years, can be 3Y. And that benefit much more than is much more than, let's say, $0 to $100 million one-time investment.
Okay.
So it's obviously very beneficial, and this venture also relies on PB Fintech. So this venture relies on PB Fintech for demand generation to educate customers. This is a great model.
Okay. So would you reckon, therefore, Yashish, the other point is, what the venture does in a good scenario, and we really hope it succeeds, could be great from an investment perspective. I'm guessing healthcare would see multiple such options available. Would you want to venture into stuff like this, which also has business benefits, but also investment benefits? Just trying to understand the thought process here.
See, we don't invest very easily. We are not a very acquisitive company or a very investment-oriented company. But this just makes so much sense that we cannot not invest in it. And the advantage to both sides is, and the synergies are so high that it would be very foolish for us to sit out when something like this happens. When XYZ is happening, for PB Fintech to say, I will have no role whatsoever in it, I think would not be smart.
Timeline you're seeing, Yashish, to execute this acquisition of XYZ?
I would say quarters, not years, but unlikely to be weeks or months.
Less than 4.
I think that kind of gives you a broad indication of timelines.
So more than 2, less than 4.
I don't know. I can't be that. It depends on XYZ, right? XYZ has to put together its consortia of investors.
Yeah.
And they have that task also. And they're talking to healthcare companies. They're probably talking to insurance companies. They're probably talking to development finance institutions. PB Fintech would be, management would love to take this to the board for approval. But it is still subject to board approval. But PB Fintech, in a way, would be ready to do its part. But the remaining 70 to 80% investment also has to be, organized. And that is a job that XYZ is concluding.
And XYZ would service only PB Fintech or other insurers as well?
It's for the insurance industry.
Okay.
It is not in any way, shape or form. PB Fintech is a minority investor, as might some insurance companies be.
Okay, understood. Thank you so much, Yashish. I wish we could speak more, but markets are going to open in a couple of minutes. Best of luck, because if it's something that changes the experience of Indians grappling with healthcare and health insurance, that really will be something to watch out for. Yashish Dahiya there of PB Fintech on their foray. Just about a minute left. Quick last call. Soni Patnaik, top call this morning after seeing what the pre-open is looking like.
So Tamanna, I'll go with the realty space. Overall realty, which has again seen very strong rollovers for the October series, and it has just hit its support of around 80, 90 odd levels. The stock has also given a very strong, breakout on the month-on-month basis. So I think overall reality with a stop loss of 1850, one can look for higher targets of 2050 to 2100 for the October series.
And Kush, what is your top call?
Pitti Engineering starting to look attractive again. A brief round of consolidation back on the back of very good volumes on Friday, saw price action. The opening also is very encouraging. So I think for a target of 1370 and 1390, you could consider a long position despite the 1.5% of cap up opening. And the stop loss on this one will be Friday's closing of 1320.
Okay. Well, we'll watch out for that. The interesting thing, Kush, just inclined to ask you, no metal name today. The metal stocks haven't quite started off really strongly. But iron ore price futures are surging between Lloyds and MDC, Vedanta. Any stock there?
So, Niraj, Lloyds was one of our call last week around the 25th, I think, Wednesday or Thursday. So that could continue to do well. Other than that, there could be fair degree of volatility because on Friday, a lot of these names saw profit booking. So I'll wait and watch. But Lloyd Metal continues to be one of our top picks in the space.
Okay. And we just want to mark the oil marketing companies before we just kickstart the whole trade, because that's the other bucket. So very quickly, if we can mark BP, HP, IOC in the session today, they had a dream run in Friday's session. Can we just pull up the intraday or the pre-open? Well, they are quiet today. So I think in line with what the market at large seems to be doing, there's a bit of a quietness even in sectors which are expected to start off well. We'll watch out for sectors or themes which are likely to start off low. The Biocons and the Lupins of the world and maybe some others. But here come the first trades. This Monday morning, the day when we see the SEBI measures on FNO likely getting unveiled later on in the evening. But 26,108, about 0.25% lower. The IT index should come up on your screen because it was very active all through the last few days. Down a massive 1% today. Bring up the heat map. There's a lot of red, very little green, I presume, is the order of the day. No, actually, it's even Steven. So what's in the red? Hero MotoCorp down 2.5. I wonder if I missed a piece of news here. But then tech is taking a bit of a backseat. Tech, Mahindra, Infosys, etc. down in trade. ICICI, M&M, Nestle. So it's across the board really that we're seeing pullbacks, thwarted by NTPC amongst the top calls from amongst the brokerage notes with Jefferies, Morgan Stanley, etc. Everybody giving a thumbs up to the NTPC RE IPO, proposed IPO. JSW Steel, Tata Steel, Hindalco, some metals playing out. BPCL now in the green, so starting to make its presence felt. Apollo Hospitals, Power Grid, HDFC Life. But suffice to say that the real newsmakers are at the not in the index. So Tamanna will mark all of these. Just keep in mind that IT seems to be taking a bit of a backseat while metals continue the unabated run.
And Hero Moto having a down day as well today. JSW Steel, remember Sony's top call at 9 a.m. this morning on the charts, about 1.5% up. But let's look at how the indices are doing as well, including the broader indices, before we go into specific stocks that we're talking about. Metals is the story of this morning. The Nifty metal 1.5% up, and expected because iron ore prices have heated up overnight. Chinese action to try and boost their economy means we will see more of a demand worldwide for commodities, and the metal index playing in tandem. The Nifty CPSE also about 0.5% up. There would be specific things there. More red than green this morning, that's for sure. And the biggest impact on Nifty realty. Now, the concerns about the momentum continuing in real estate stocks is there for the last couple of days. We've been seeing that. Nifty realty about 1% down. Nifty IT also hurting, as well as our auto stocks. So the big winners of last week taking a breather is one way of looking at it. Let's look at what the mid cap and the small cap indices are also doing. Completely flat, in the red but flat, not as hard hit as the Nifty, which is deepening in the red now. Small cap actually in the green, not quite 0.5%, but definitely in the green. Specific stocks that we're looking at, let's take the metals theme forward. NMDC, Lloyd, these are some of the ones which have been in focus because of China's action. Do they really see the impact coming in? NMDC about 4% up now in early trade. Let me look at Varun Beverages. Varun Beverages has had an upgrade from HSBC. They've set a target price of 780. and foreign beverages has also been in focus, so we'll take a look at that. But the other stocks that are on our focus this morning is BSE and Angel One. Remember, the big story is definitely going to be on what F&O regulations show like. For BSE, like we said this morning, there's good news and there's bad news. There's fear about what SEBI could do, but they have increased their fees. That is now displaying itself 2% up there. Angel One not seeing too much pressure right now before this F&O regulations come in. Is there perhaps the thinking that at the end of the day, people will still trade no matter what the clampdown is, and you won't see too much of an impact on volumes coming in? Definitely something Avinash Gorakshikar told us. Pharma in action, Biocon, Jubilant. Let's look at both of them because of the kind of US FDA strictures. Not too bad. Biocon most hit, maybe 0.5% down, but the other two doing okay. PB Fintech, we just spoke to the management a few minutes ago. They are foraying into healthcare, but not directly. They want to create an HMO kind of a situation where you would see lesser health costs at the end of the day. The stock about 1% up. It's already run up on that news. Let's look at Varun Beverages now. Let's pull that back up. Target price set by HSBC at 780. Stock about 1% up. And Bajaj Steel also on our watch list this morning because bonus issue will be in focus. 3rd October is the date for the bonus issue. 15% up on Bajaj Steel. So action which is spread out, I would say, Niraj, not really an overall kind of an up move. Little pressure definitely there on the last trading day of September. And of course, behind the scenes, that fear of what is going to happen in the F&O space.
Yeah, I think that should be top of the mind for people for sure. So should certainly bear that in mind. We haven't seen too much of a reaction in the pharma names, but Phoenix Mills is down about 6%. There is weakness in stocks like Purvankara and some of the other real estate names because real estate sales haven't been the strongest. I think that is what is probably playing into some of the real estate names in the session today. On the flip side, despite being in SMZ Media, up another 7%, and stocks like JM Financial and a few others are showing some bit of a bounce. So therefore, those have to be kept in mind. 150 for a JM Financial in the session today. Actually, just quick opening thoughts really before I go to Avinash Gorakshekar. Kush, you were constructive on JM some time back. I don't know if you took the chips off the table or no, but what do the charts suggest here? Because brokerage names I thought largely should be under pressure today. They're not. At least JM Financial isn't.
So, Niraj, I think this is one stock that we've been discussing from about 95 odd levels, and every time the discussion happens, you see a spike in volumes, accompanied by the spike in price. So, as long as the stock doesn't tell you that there are signs of fatigue or probably consolidation, even on the volume front, forget the price action, the volumes have kept on spiking. So I will continue to hold this. I will keep moving my trailing stop loss higher. So now my trailing stop loss will be somewhere close to 143, and I'll continue to ride this wave. So anyone who's holding it should ideally continue to ride this because, as I said, the price action is solid and the volumes keep picking up despite the kind of amazing run up that we've seen over the last month or so.
The Nifty IT and the Nifty Bank are down. The mid caps, small caps, not so much. So it just shows that the large caps are under a bit more pressure than the mid caps because the market-wide advanced decline ratio is not looking all that tough. Sony, opening thoughts? Anything that stands out?
So Niraj, we'll wait for a while. I think one can just actually look to indices for now. There's a possibility of Nifty testing the support of 26,000. Any break of Nifty in 26,000 spot level during the day can see another 100 points of a profit booking for the day. So there's a small opportunity for a short call in Nifty. If possible, it can break 26,000 and look for targets of 25,900 as the profit booking is on its way.
Okay. Avinash, one of the talking points in Friday's session were oil marketing companies. They are a bit soft today. Sony has a call today, a trading call too. Fundamentally, would you be a buyer into BPHP or IOC?
Yeah, I think, Niraj, if you look at the buoyancy in the automotive and the aviation sectors, I think we are going to see a gradual softening trend in crude oil prices. Already, the OPEC has indicated, Saudi Arabia has indicated that possibly in the coming month, supply is going to increase. So my sense is that this could be a good kind of opportunity for these companies to ramp up their gross refining margins. And I think most importantly, the kind of throughput growth which we are looking, specifically from the aviation and the automotive space, I think stocks like BPCL, HPCL can definitely be looked upon from a near-term perspective. I think any improvement on the crude oil price front, in terms of softening price, would obviously bolster their margins. And I think despite the fact that these are momentum stocks, the improvement in the margins would definitely give us sort of re-rating, at least in the near term, for all these companies.
Avinash, you're not penciling in petrol diesel cuts before the elections?
No, I don't think, Tamanna, see, these are things which markets always discount. But I think maybe in the short term, it could be a little bit of a knee-jerk correction. But I think looking at the throughput increase in both aviation and I would not be surprised that maybe 1 quarter they could lose out. But again, once the elections are over, I think post Diwali we are going to have Maharashtra state. I think nothing dramatic or some sort of panic sell-off here. One could see a little bit of a slower kind of movement here. But medium to longer term, if crude continues to be soft, that gives a good runway for these companies to grow forward.
Okay, metals also in focus, and Sony, you talked about JSW Steel.
In breakout, the stock on any small declines towards 515 to 512 can be a
those elevated levels also still away from overheated territory, so you could look at Hindalco for a target of 775, 780 perspective that you could move into.
What about autos? Let's take a look at autos. Hero Moto now deepening cuts to about 2.5%. TVS Motors looking weak. So is M&M. Maruti, after its massive runoff last week, is now seeing some pressure. Anything that you would pick up right now at these levels, Kush, from the auto space?
So as long as Maruti sustains above 13,000, it makes a good buy, because now that strong resistance level of 13,000 will act as a strong support. M&M also, but what you're looking at today in M&M and some of these names, is more of profit booking. So I'm not too concerned about the kind of dip that we are seeing today. Maruti, as long as it holds 13,000, you could look at fresh additions also for a move towards 13,700, 14,000 kind of levels. M&M, as I said, even though it looks attractive, because it's at the low point of the day today, even if it's been like 10 minutes to start, I would wait to see where this fall settles and then consider a re-entry from a trading perspective. But for now, Maruti. Okay,
Maruti is top pick there. What about you, Avinash? Are you liking anything in the auto space to pick up right now, or you'd stay away after the kind of run up and then now profit booking that we're seeing?
So I think, Tamanna, I would prefer to wait. I think Q2 numbers are expected. So I think probably, once the second quarter numbers are out, we get to hear the management commentaries. I think second half is definitely going to be much better. But I would prefer to hold, stocks like Mahindra and Maruti, where we feel that there's a decent amount of order book, decent amount of traction. In the near term, these stocks could be volatile. But I think once we get the second quarter number, and the first half performance, I think that would give a better sense as to what the management outlook is for the remaining part of the year. So I think it's a hold. Fresh buying is not advisable at these days.
Okay. Well, but keep an eye out on metals most importantly, because I think that's a bucket that you certainly want to watch out for. So NMDC being up, nearly 4% today, if I'm not wrong, or 3.5%, 3.79% as iron ore prices have risen. Mahika, the reasons, we spoke about them, but enumerate for us the reasons again, and more importantly, what is the kind of impact that comes on to the earnings of or the EBITDA of businesses like NMDC or Vedanta or Lloyds as a result of these iron ore price moves?
A rise in iron ore prices directly impacts these metal miners, and it's a key positive for these companies because they are one of the largest miners of iron ore. So the global prices directly have an impact and spill through to the domestic prices as well. Now, the latest surge on NMDC specifically is because of the iron ore prices. Now, iron ore futures were up 10.59% in an intraday today. Prices are around $111 per ton when they were just around $92 just a few days ago. Now, future prices are up 23.85% in the past week, and it's key to be noted that iron ore has been one of the worst performing commodities this year because of China. Now, why have prices gained? Well, 3 of the biggest Chinese cities have eased their home buying curbs. Guangzhou city has removed all restrictions on their home buyers. Shanghai and Shenzhen have lowered the minimum down payment ratios for first and second homes to 15% and 20% respectively, and the easing of these curbs is expected to bolster demand for the world's biggest iron ore consumer because it helps and instills a positive demand outlook for its real estate sector and its infra project sector, which has been on a downturn, for the past few years. When you talk about why the prices were under pressure in 2024, well, it's mainly because of oversupply. China's ports are holding around 150 million tons of iron ore, and China is a big iron ore importer, and the lower Chinese demands were unable to absorb the extra imports. But however, the latest economic stimulus package that has been announced by China has surely been taken well by the metal counters.
Okay, so metal counters in focus, NMDC definitely with that kind of a runaway today, and just take a look at NTPC as well. NTPC 2 notes out today, which is why you're seeing so much of an excitement in the stock generally speaking. Morgan Stanley has maintained an overweight on NTCP at 496 as a target, and they say the bull case, of course, is renewable energy portfolio valued at 1.3 lakh crore rupees. In the base case, that portfolio is valued at 47,700 crore rupees. The NTPC Green IPO is actually what's exciting them. Same with Jefferies, which has maintained a buy on NTPC at a 485 rupee target, 12% upside, because they're saying the NTPC Green IPO will potentially add 5 to 11% upside for NTPC. Avinash, just as a strategy to get some shareholder quota from NTPC for NTPC Green, does it make sense? And what about the benefit that NTPC itself has?
Idea, Tamanna, that one can buy NTPC shares, because usually we have seen what happened in Bajaj Housing. Shareholder quota is a very important component, for applicants. So I think most people in the market are buying, shares of NTPC in the hope that there will be a shareholder quota announced for NTPC Green. And it's one of those marquee green energy companies which has got a very strong profit track record, a very healthy order book. As far as NTPC is concerned, I think once the stock gets listed, NTPC Green, it's going to definitely add a lot of value unlocking for the parent company. Value unlocking would obviously mean, that the stock would get listed, and obviously that would benefit the parent. So to that extent, the parent company would benefit. But I think for retail shareholders, it makes sense to buy NTPC at least in small quantities, so that they get eligible in the shareholders quota, which typically can help their chances of getting allotment in the NTPC Green IPO, which is going to be another record offer.
Okay, NTPC on the charts. Do you like it, Kush?
Not too bad, but I think a fair bit of run-up has already happened, and plus the stock's not able to sustain the highs that it's making on the last couple of days. So my suggestion, you want to play this for the medium term, then perfectly fine for targets of 460 and higher. You could consider an entry with a stop loss around 425. But from a trading perspective, not so attractive at the moment.
Post the opening sort of settling, what are you seeing as the big breakout for the day?
it's actually more of a breakdown, because there was a fair attempt, at least on the bank Nifty, towards a recovery, but then that's not sustained, and we're close to the low point of the day. Even if it's been 15 minutes, we're not seeing any signs of recovery. So you might want to wait and see, if this level, 26,000 on the Nifty, 53,300 on the bank Nifty is indeed maintained, and then you consider long positions. Otherwise, you perhaps just wait and watch for the day. Let the markets consolidate. Not a bad idea.
Well, there was Diwali and Dussehra, Kush, but sometimes the market just does what it does. But I'm just wondering, Kush, none of the pharma names are suggesting any breakdowns, the Biocons, Lupins of the world, because all of them have tough news around them this morning. Would you trade any of them?
So Sun Pharma, yes, that's the one on the decline that makes a lot of sense. Biocon, Biocon's had a history where it's been a little mixed bag. After the news comes out, the stock actually goes into correction, consolidation. So I would wait, and if I were to short Biocon, that will be once it closes below, or maybe trades for a while below 360. So not a very big fan of the stock, especially given the kind of history that it's shown. So if you want to short Biocon, you should consider below the levels of 360 with a stop loss at around 370, and then you play for support levels of 345 and 330. So Biocon, consider short only if it stays or closes below 360.
Okay, viewers, I'll tell you. So what's happened on some of the pharma names just before we get in our guests there. And Kush, stay on. Just would love to get your technical thoughts if we have 5 more minutes. Avinash, take a moment to thank you, of course, for joining in today and giving us your thoughts. Really appreciate your time this morning. Much appreciate this. Okay, viewers, I'll tell you what's happened with pharmaceuticals. Now, there are, after a really calm period for 2 or 3 years post-COVID until 2022 or 23, the US FDA action, there's a flurry of US FDA action. And maybe a lot of times it's great news, because we've seen even Indian entities or the Indian regulator kind of saying that in some medications there is an issue, and the companies are saying that it's not manufactured by them but some of the others. But the point is, the last 3 months we've seen a flurry of US FDA activity on a clutch of pharmaceutical names. Now, over the last 48 or 72 hours, there are 4 or 5 US FDA inspection outcomes that have happened, including Alembic, which we haven't spoken about, including Piramal Pharma, which has actually not had any problems with the reports that have been given out. But the others, which is Biocon, which is Lupin, the 2 of them, and Jubilant Pharma over the 3rd one, all of them at different facilities have gotten different kind of measures or actions that have come in from the US FDA. And Tamanna, I just wonder, for as long as I remember that I've been reporting, and maybe it's just the natural course of action because these businesses are difficult to upkeep maybe, but the US FDA action kind of comes in spurts, stays for a year or 2 in a meaningful way, and then tends to die down. Some companies do it fabulously well. I remember Lupin, until last year, has not had a single blemish. Suddenly, there are 2 or 3 or 4 US FDA observations and Form 483s or what have you that have come about. So
a couple of things at least that I have noticed, Niraj. One is that the frequency and severity of the action has come down. Indian pharma companies are sort of getting their quote-unquote act together in that sense. And also the street does not take it as negatively as they have perhaps. Maybe in some cases, like recently there was a company which the charge was that you had not even given material input, that you had destroyed evidence. So then that's a serious thing. But if it's not that, if it's a routine one, then the street doesn't seem to get too bothered, is what I've noticed at least. All right, Aditya Khemka is joining us now. He's fund manager in Incred Asset Management and tracks the space very, very closely. Aditya, great to have you on, especially on a day when, we've had so much action come in over the last couple of days, 48 hours or so on companies, and you can help us break it down. Let's start with Biocon, Lupin, Jubilant, because these are the ones which have seen action in the last few days. Do you think that these are big negatives for these companies?
So good morning and thanks for having me. To begin with, let's talk about Biocon. I think Biocon's Malaysia facility is really important for them. It's a facility that can produce insulin and other products. It's a facility where they've done very meaningful capex, and if the US FDA observations escalate, it would be a difficult issue with Biocon. They will probably not be able to show significant earnings growth, which is expected out of them as of now. And that will create a problem for the company's stock price and future earnings growth trajectory. On Jubilant Pharma, I think the facility is insignificant in the scheme of things. The facility was already under OAI, so another sort of OAI label on the facility doesn't change anything for them. So I don't see any significant impact on Jubilant Pharma from the impact that they had. Lupin, again, they have so many facilities and so many of their ANDAs are sort of diversified across facilities. I would imagine very limited impact on Lupin's, revenue trajectory and margins trajectory because of this issue.
Okay. Standard disclosures, of course, viewers, keep in mind, it's just just a view and not a buy, sell, hold recommendation from Aditya. Aditya, great having you. Thanks for joining in, Niraj here. So, Aditya, just a broad talking point. Do you reckon the US FDA scrutiny has intensified in the recent times? Are companies doing something wrong, or is this a normal cycle which follows? Because at times lapses may happen. How do you read into this?
So I don't think the US FDA scrutiny is intensified or otherwise. I think it's a regular act of the regulator. They have to keep auditing these facilities from time to time. I think the problem really lies, Niraj, in the economics. So the end market is not giving you good pricing, good margins, and the regulator is sort of increasing the bar for compliance time and again. And if the companies sort of, do the whole compliance bit, maybe the cost economics don't work out. And hence, maybe at some level, I'm not blaming the top management or the company's promoters or something like that. I'm just saying at some level, people just take shortcuts to, sort of keep the cost low or accelerate the dispatch of material or production lines or whatever. And I think that sort of gets caught in the net with the US FDA because they don't like people taking shortcuts. They like to be thorough with the processes. And I think that has forever been the case with Indian pharma now. I think for about 10, 12 years, we have seen this now. It's disheartening. But again, the only way out of this is to keep training, to keep sort of your personnel updated about the regulations, to keep training them, and that's the only way out of it.
Would you say that some of these businesses have had a material, the recent developments over the weekend? So I thought that Lupin's Pithampur facility was a key one for its US supplies, but I heard you say that Lupin has ANDA spread across, and therefore it may not be as big as would it be safe to say it's not as damaging?
Yeah, that's correct. I think majority of Lupin's ANDAs have dual filing sites. At least that's what they tell us. So, if this, let's say this facility were to come under a warning letter or something like that, Lupin would probably be able to get the approval of those ANDAs from alternate sites.
Okay. So, Aditya, thanks for this first piece of information on this. The other one is this whole passage of the Biosecure Act and how people took a bit of a liking. But I thought it was long drawn. I was talking to Sinjin and they mentioned that there is nothing in the near term that's going to happen. How do you look at this? Is it one of the many things, or is it really a big material development for Indian CDMO players?
So look, it's a material development from the standpoint that it gives the stance of the Western countries and Western companies towards Chinese suppliers. From that context, it is material. From that intent, it is material. But for the pharma companies of India, which have the potential of replacing those Chinese suppliers, it's going to take time. Pharma is a regulated sector, Niraj. You have dossiers, you have so many files and so many compliances to be met before you can produce the first commercial batch. I mean, it can take 2 to 3 years sometimes just to get the filing transferred from a Chinese CDMO or to add an Indian CDMO to a Chinese CDMO product. So it's a long drawn process. So I understand the street's enthusiasm at this point in time, but I think a lot of the future growth in some of these companies is getting discounted in their current valuations, which makes us slightly uncomfortable. Because if then the growth falters for even a year or two, maybe sometimes even just a couple of quarters, we have a lot of volatility in stock prices, which obviously investors do not like.
Aditya, just among the lot that we've spoken about, and let's get some of those picks in, because you had one more news in the pharma space recently, which was the CDSCO saying that the quality checks that they usually conduct saw some very key brands and very popular brands not passing muster. And then you had various, some companies coming and saying that this is not ours. Then there was a version saying that these are not made it to market yet. Is this quality check business going to become a problem? If yes, for which companies?
So I think, look, if you look at the Indian pharma market, there are close to 16,000 companies that sell products in India, under their labels. And there are many contract manufacturers. I think it turns into, again, tens of thousands of contract manufacturers. But there are only 3, 4, 5 large contract manufacturers who account for a substantial portion of the market. And a lot of the good companies that we talk about, a lot of the large companies that we talk about, they either manufacture their product themselves or they outsource to these 3, 4, 5 large CDMO players, where I don't expect any quality issues to emerge out of those 4 or 5 CDMO players, because these are WHO GMP certified players and all of their facilities are WHO GMP audited. So they are not sort of probably going to fail on that. Remember, WHO GMP is not as not as difficult to pass as, let's say, a US FDA inspection. The rules are relatively more relaxed. So I think from that standpoint, I wouldn't believe that many of these large pharma companies that we invest in or we talk about, they will have issues with their product quality. So I am inclined to believe when they say that some of our brands which have been sampled by the CDSCO and flagged off as substandard isn't really our product. It is a spurious product which was being labeled as our product. India has the problem of spurious drugs for a very long time. It is our regulators, whose job it is to figure out where those spurious drugs come from and to stop the flow. So if you're finding substandard drugs, it is probably the next step to take is to find the origin of the substandard drug. Is it the company that owns the brand, or is it just a spurious company which is putting the product. So I don't think this is going to be an everlasting situation. I think this is just a blip, and there are definitely spurious drugs available which sell under the popular brands. Our brands which have been sampled by the CDSCO and flagged off as substandard isn't really our product. It is a spurious product which was being labeled as our product. India has the problem of spurious drugs for a very long time. It is our regulators, whose job it is to figure out where those spurious drugs come from and to stop the flow. So if you're finding substandard drugs, it is probably the next step to take is to find the origin of the substandard drug. Is it the company that owns the brand? Or
insurance as well as hospitalization bills for the individual, as well as, conflict of interest.
They're talking about opening a health insurance arm. So sort of a new, trend where we are noticing that these companies want to integrations in terms of their
Aditya, sorry, yeah. Aditya, may I just... So Yashish Daya said that they are not going to run that business. They said it's an investment into that business, one hospital or set of 7, 8 hospitals, which Yashish Daya was saying. Can it have an impact on the existing hospitals wherein there is a conflict between the hospital and the insurance company?
So I actually don't agree with the premise there. I don't think there is a conflict of interest between the hospital and the insurance company. Okay. You may think it's about the bills. I am thinking it's more about the volumes.
The rest of the financial year?
Absolutely. So I think hospitals for the past 4-5 years have done phenomenally well in terms of ARPOB growth and occupancy growth. We don't see the trend changing anytime soon. So we expect all hospitals companies to come out with sort of low teen to mid-teen top line and slightly higher bottom line growth throughout this fiscal. And that's sort of a significant growth number given that the overall Nifty 50 earnings grew 9% in 1Q FY25. So you clearly have a subsector within the market which is growing significantly faster than the broader market index.
All right. Thank you so much for coming in and speaking with us. Aditya Khemka, they're talking about the pharma space. It has been in action. A lot of observations from the US FDA, but not too much impact that we have seen on some of those pharma stocks today. The index down about 0.5%. That's not what's happening in metals, though. Metals is in focus, and we're speaking today with R.V. Gumaste, Managing Director at Kirloskar Ferrous Industries. Mr. Gumaste, sir, very good morning to you, Mr. Gumaste. Thank you so much for speaking with us. And let's just start with the, I think, big story or the big move for you this year, which is merging your companies into a single entity in 2024. That's with Indian Seamless Metal Tubes, IMST. Tell us the kind of synergies that creates.
Yeah, we acquired Indian Seamless Metal Tubes, or ISMT Limited, in March 22. And immediately after acquisition, we had already announced that we would like to merge this entity into Kirloskar Ferrous Industries Limited. It makes sense because it's a forward integration for our pig iron business. We look forward more and more integration coming forward with setting up of the steel plant in Koppal plant to supply the steel blooms to Baramati plant. I think from many angles, we are going green power in ISMT that can go for the steel making. We are looking at complete integration and bringing the value chain, starting with iron ore mining, going up to the seamless tubes. I think it makes good sense to merge these entities, and then at the earliest opportunity, we went ahead and merged. We had confidence on turning around this company, and we could turn around the ISMT to profit in first quarter. And we had no doubts that it's a valuable asset to run it as an integrated entity within Kirloskar Ferrous Industries.
Tell us about, you talked about the green energy in ISMT helping. Tell us about the solar project, which allows power cost reductions. What is that pegged at for the combined entity?
See, we are looking towards the opportunities on solar and wind, complete green energy. Not only from the cost angle, cost is very important, and today solar and wind have become competitive. But we have huge commitment to going green, reducing carbon emission, and to take the steel to green steel manufacturer. I think from both aspects, I think it makes a huge sense to expand our green energy footprint. We have gone ahead with the 70 megawatt first, and half of it is commissioned. The balance 35 megawatt will get commissioned in October, November. And by the year end, we will go to 100 megawatt. I think we have already contracted to complete 100 megawatts before the end of this financial year. Going forward, we would like to expand to whatever level we are allowed to use the green power, especially the solar. I think today's regulations permit us to go up to 74% of our requirement, and we are committed to moving in that direction. We have already started investments into wind power as well, because these are complementary. The monsoon months, we generate more wind power and less solar power. We would like to bring that blend so that we increase our share of green energy in the total energy consumption in steel making.
What is the kind of impact that we will see on margins as these green energy initiatives help reduce costs, and by when?
I think it's quite dynamic when we are looking at the opportunities to cut costs. Customers are also looking at how our cost can come down and they can get the benefit. I think it's going to be a very, very substantial impact. Currently, we are at power and fuel cost of 15-16%, and we intend to take this power and fuel cost down to 6-7% over the next 2-3 years.
Just want to understand your production targets right now, Mr. Gumaste, and if you are seeing any impact in what we've seen in commodity prices. Overall, we've seen commodity prices zoom because of what we've seen in China in the last couple of days. This cycle might improve and increase. What is the kind of impact you see for you?
No, the first part I will cover first. The commodity cycles you have seen last 2-3 years, there's no bottom at all, and it just kept going down. Even though the input raw materials did not go down that much, but the metals prices went down. And we were keen on to see where it stops and we get some support. I think last maybe 1 week or so, we see some support coming for the steel scrap as well as for the metals and pig iron and steel. And I would see end of the monsoon should improve the construction activity across India, and some demand for the iron and steel should revive. I think that support is very essential because the metal prices have gone down, especially the iron and steel.
So what is the kind of price bump up that you expect?
Right now, I am able to see on the pig iron and steel about 2,000 rupees per ton support coming. How much will sustain, whether it will further go up, we have to wait and watch.
No impact on demand as a result of that?
The demand, whenever there is a price increase, it's a clear indication of demand improvement. So I expect that with the price improvement, the demand improvement will also happen, and we should be able to sell all our products and run all the 3 furnaces full blast.
Let me come to the targets, guidance and targets that you have set out for FY25, Mr. Kumaste. So your production capacity target for pig iron, for example, is at 1.5 lakh metric ton, volumes of 54,000 to 55,000 metric ton per month. Are you on track to achieve this for this financial year?
We got some setback in the Q1, but Q2, Q3, I see alignment in the volumes. We are running all the blast furnaces and we are able to sell. But this 1,50,000 sales now includes the sale to ISMT steel plant Jejuri. So our external sales of pig iron today is of the order of 43,000 metric ton per month. Because after the merger, the ISMT sale is internal transfer.
Okay, and in terms of guidance for casting and tube, are those also on track?
I think there has been a smart improvement, especially for us in the casting business. The demand has improved, though auto industry and tractor are subdued. But so far we have been able to hold on to the volumes, improved volumes in Q2. And we are looking forward that with the festive season, some support should come and Q3 and 4 should become better. And except the Q1 volume, what went low, other should get normalized and we should go closer to the targets.
Are you seeing a pickup in Q2 volumes in the auto space?
Yeah, definitely much better than Q1. And there have been very big challenges on sustaining those levels. And but as you know, we are into very special castings and not general products. And we are finding slightly better volume stability than actual market condition.
Okay, thank you so much for speaking with us. R.V. Kumaste, the Managing Director at Kirloskar Ferris, talking about how definitely for the auto space, which is a big part of what they supply to, the pickup is definitely being seen in Q2 compared to Q1. Another stock which is in focus is Varun Beverages. HSBC has initiated coverage on the stock with a buy stance. The stock definitely opened up, but now is seeing some pressure coming in. But Mahima, tell us why HSBC is excited about Varun.
Right, so the target price that HSBC has given is 780, which gives an upside of 24% from Varun Beverages Friday's closing price. Now, what they're saying is that India's bottling race is about to intensify, and Varun Beverages is the best player to leverage this. And disruptive digital market development models for driving sales is coming to India with AI, and this could help Varun Beverages. Now, Varun Beverages can become the largest and most disruptive PepsiCo bottler, and it is also planning to add 300 to 400 lakh outlets per year to drive high highest offering per capita consumption, and this could possibly drive the stock run up as well. Now, in terms of outlet additions and digital market development models, this remains these are the two main growth drivers in the near term future, and they also expect double-digit volume growth via geographical expansion. However, key risk that the note mentions includes that not keeping up pace with the leaders' new requisite market development tools and culture. So this is the overall view of what HSBC has to say about Varun Beverages.
Okay. Varun Beverages, though, seeing some buying pressure coming in, so is most of the market, to be honest.
I thought the one line in this, right, it's that Varun has the chance to be the largest bottler for PepsiCo in its history. I know it's a derived business. It's not like starting a Pepsi business, but still a bottling unit is a tough business for Varun, because it's now got multinational operations for PepsiCo. To be the largest bottler in PepsiCo's history is quite a telling thing for a company which has come into fanfare only in the last 2 or 3 years.
Correct. And no, it's huge. It's huge because demand also sustaining. I mean, that is one space long term. Sodas have always, seen a lot of pressure. Last few years, definitely more so than ever. But then this is also a management and a company which has shown the ability to be nimble
and innovate.
Yeah.
The energy drink, I think it's Sting, right? If I'm not wrong. Pricing it at $20 versus Red Bull at 110, 120. And then just having such volumes, it's great.
Yeah, I mean, that's something that all the kids are having. The kids and Niraj love Sting. Not sure about him. But anyway, the sting definitely being felt in the market today. No doubt about that. Is this the concern of what happens later this evening when the SEBI board meet ends, and then we could see some stance on F&O regulations? Just to give you a primer of what's happening there, volumes on the derivative side have been expanding rapidly. 90% of those volumes are coming in, of the overall market volumes are coming in from F&O. As recent SEBI study talked about how 9 in 10 investors, retail investors, actually 9 in 10 of all investors are losing money in futures and options, but 3/4 of them still come back and still continue to invest. And that really is a concern that perhaps SEBI will address today. So you're seeing the Nifty deepening in the red right now, 3/4% down in trade right now. And that, I don't know, there's a new listing, Manba Finance, which had got a massive response from shareholders. Is it going to be bad timing for them, or will they make the cut? Let's just take a look. You're seeing live pictures there of the listing ceremony coming in from NSE, and the kind of enthusiasm for this was just insane.
224 times, Tamanna, and if this wasn't enough, on October 3rd, we'll have KRN2 with 200 times. But this is quite stunning, the way IPOs are getting subscribed, and it'll be interesting to see the listing price of Manba and how it opens up. But let's get the price up on the screen. Okay, it's a sedate start, I must say.
Yeah, it's bad timing, I would think, more than anything else, because with that kind of subscription appetite, maybe it'll pick up, but 25% up. We are used to seeing, 3-digit kind of increases. Maybe we're just a bit spoiled. But on a ticket size that wasn't that big, maybe I would say, 25% upside is a bit of a sedate listing. Let's see if it sustains at those levels. So it's a finance company, 2 and 3 wheelers is what it looks like largely, and they're having, maybe the timing also is a little off, but we'll wait and see. We'll wait and see how Manba does through the day. It's the new kid on the block.
Yeah, this is a big surprise, I must say.
Yeah,
but maybe,
it's all about timing.
Yeah, but maybe this, just before we wrap up, this does the other thing of letting people know that not all listings are just predictable on the basis of subscription.
Yes.
Nor is it that every IPO should you just be blind. I mean, Manba is a great company because it's got, I'm presuming because it's got the response that it has. But maybe people need to be picky and choosy about IPOs as well.
Always. Picky and choosy on IPOs is what everyone will tell you. It sounds boring, but that's what every analyst and advisor will tell you as well. Wait for it to settle. 152 rupees on Manba, about 27% up from its issue price. With that, it's a wrap on India Market Open. Thank you so much for speaking with us, but stay tuned. Talking Point up next. We will be hearing from Jeetu Punjabi about markets and more.
Thanks for tuning into today's Talking Point. I'm your host, Niraj Shah. Our guest today is Jeetu Punjabi of EM Capital Advisors. Jeetu, great having you. Thanks for joining in.
Thank you very much. Thank you for hosting me.
It's been a long time. I mean, it's been what, maybe 18 months since we last spoke. Now, Jeetu, when we last spoke, which was probably March or April 2023, right? You were structurally skittish, cyclically constructive. If I got that right.
Absolutely right.
Yeah. What's changed from then and now?
So, if you look back at the last 18 months, we've had a really good 18 months. We've seen liquidity turn positively. We've seen a lot of countries do really well, and markets have been raging. I think we're at an inflection point where this is about to change, right? So we've been in a high return, low volatility market. I think that is just reversed. The next 6 to 9 months, we're going to be in a low return, high volatility market. If you ask me, put a gun to my head and say, what do I think markets do globally next 6 to 9 months? My best guess, zero return, probably plus to minus 5. With huge volatility. Second dimension of the market that's changed is we've been in a top-down market. So like in places like India, you've had themes like railways and defense and a lot of other, short financials, for example. I think the market moves to a bottom-up market. Within the environment, within a sector, you'll have 5 companies that do well and 3 that don't. And you're in cherry-picking zone. You've got to go and pick the right company. You've got to make sure the company does it right, and just a top-down call is going to be much tougher to make. So I think this is really what's changed, and you got to change the game where the market changes.
So it seems a bit counterintuitive, Jeetu, in that we're talking of the US economy being in a Goldilocks scenario, India being one of the few, and maybe you were talking about this from a global market perspective, but still, US doing okay. We are at the start of an easing cycle. China has done some moves as well to revive growth. So global GDP may not look as bad over the next 12 months as people might have feared it to be. And you're saying that we will not have returns at all.
Yeah, so I think, there are 2 dimensions to it, right? One, I very respectfully disagree that the world is in a good shape. I think US is in a very difficult shape. Okay. We saw the consumer confidence data collapse in the last month's print. We've seen Chinese profit data collapse, 18% fall in Chinese profits after a huge collapse for many years. So my point, and if I look at Europe, if I see the advisories that have come out of the large European autos, everyone is saying we were expecting 2% growth, now we're going to be down 5 or 7 or 9%. And 2, the profits are going to collapse. I don't think this is in market horizons. If I see what the markets are saying, I think there's a disagreement between what the markets are saying and where I think the world is heading. It's just where I'm coming in and saying I think the global economy looks really, really difficult. Data will show you in the next 6 months that things don't look good. The rate cut was clearly needed. Maybe 50 is not enough. Maybe you need another 50 by December. I think you saw the Swiss National Bank yesterday cut. I think you're going to have a synchronous rate cut cycle globally. Including India by the end of the year. And I think you're at a point where all this is needed. Now, why do you cut? Because things are bad. Things aren't good. And you're going to see it in the numbers. So on one side, you'll have fundamental numbers going down. The other side, you'll have liquidity going up. There's a push and a pull. Markets are overvalued globally, especially the US. And you'll see the push and the pull result in high volatility. And flat markets is my best guess.
Okay, so I completely agree, but what I meant to ask was that we know that the world growth numbers, save for maybe US, and you said you disagree, but let's assume that some people believe that that number is still looking okay, and a few other markets looking okay. So growth is, I'm not disputing on that on growth, but you don't believe that markets can still deliver positive returns in an easing cycle. You don't think that will happen. Central banks have moved the markets since the COVID lows. You don't think?
So if the valuations were not where they were,
okay,
I would agree with you. I don't think the valuations, our models, and these are 30, 40-year models, are saying valuations are stretched. Can liquidity still push it up? Can there be other stuff happening? Possible. But I think it's going to be a lot tougher. And the numbers are just not going to look good. They're just not pricing in what the real world is doing. In my view, the last 2 months, the high frequency data in the last 2 months is much worse, especially in Europe, than most people expect.
Got it. And which is where I'll invoke in the second half of our conversation, what does it mean for Indian companies which are outward facing versus domestic facing as well? And can India be slightly different? But just before I come to India, Jeetu, a word on China, because I know you look at that very, very closely, the data coming from there and the implications thereof. China has made some serious changes to what it has been doing for the last 12 months, in the last 2 months, and especially in the last few days as well. What do you make of all the moves that have happened in China and the resultant implications on commodities and on other economies, if you will?
Okay, so this is a great question. In the way I've been watching China for almost 24, 25 years as an analyst and been continuing to do that. The last 7 weeks, China's completely changed tack, completely.
Please explain.
And I don't some markets have recognized it, but I think the policy side needs to recognize it too. So let me explain, right?
Happen in China and the resultant implications on commodities and on other economies, if you will.
Okay, so this is a great question. In the way I've been watching China for almost 24, 25 years as an analyst and been continuing to do that. The last 7 weeks, China's completely changed tack, completely.
Please explain.
And I don't think some markets have recognized it, but I think the policy side needs to recognize it too. So let me explain, right? They let the currency go down and they neutralized the pain on inflation and anything else by using monetary policy. Since July 26th or 27, the FX appreciation game started. The Chinese yuan is more than 4.5% up since. And this is a big change, a huge change to do in 7 weeks. And what you normally do is when you have an FX tightening, you do a monetary easing. And they started the monetary easing last week, right? So you can see two legs happening, the entire change happening. I see other countries haven't done the same. So do I think India's behind the curve on this? Yes. Do I think Governor Das is going to look at this and say, yes, he needs to be following the same trajectory? I think so.
Okay. So, okay, let me just squeeze in that question and then I come back to the Chinese impact. But you reckon that by virtue of the fact that US easing cycle has begun, and that is to a lot of people a bit of a trigger as well for India, and the fact that China has done this leads to an October policy change?
I don't know whether it's October or December. In my humble opinion, you need to ease liquidity first before you cut rates. Okay, so all the interventions in the FX markets needs to pause. You need the rupee to appreciate at least 1% or 2%, and then you need because you have a problem of deposits in the system. So unless liquidity flows into the system and flushes the system, a rate cut might create other problems, and you need to do that. But essentially, if we're sitting 6 months from now, there has to be a significant easing cycle, and the RBI knows what best to do. First, second, third, all that, they understand that well.
I'm sure they do. Okay, Jitu, coming back to China, sorry, because I want to understand that. Now that there is a move that has happened, and people have been crying for months about how China is not making any kind of policy move, they've made a move. There has been a resultant impact in that the Chinese markets have done well, metals and commodities have done well, save for crude, but industrial metals have done really well. What happens next? And now that the first signs of the move have come, there might be more things that might happen, assuming that those happen as well. How do you see Chinese markets? How do you see commodity markets? And the resultant impact of what China does in other markets happening over the next 2 months.
Okay, so let's first understand what's the problem in China. A lot of problems in China are structural, right? You have a policy leadership that has issues of its own. There are battles within that. Two, the real estate sector has huge oversupply. Digesting that and cleaning up the system and the deflation that's ensuing is a significant structural problem. It's going to take 5-7 years to solve. And the third, the collateral damage on the household balance sheet and confidence isn't going away. So the point is, and then on top of that, you have an export chain, in my view, which is going to see much more pressure in the coming quarter or two. And the only way you can do is throw more money into the system, create more domestic demand, and try and neutralize that pain. Now, that's what I can see they're visibly doing, right? A 4% move on the FX, plus monetary easing, and they hopefully kind of buffer the downturn, the pressure on the downside, right? How does this play out on your commodity markets? In my view, the demand is still very, very weak. Is the real estate sector going to structurally turn? Answers no. Is there a big upside there? Answers no. Is commodities going to be exported the hell out of globally? Yes, they're doing it. Is the world in great shape to absorb that? I don't think so. So this commodity move is a financial market move, in my humble opinion. Do I see volume changing in a big hurry? I don't think so. And it just wobbles around, and which is where I come into the high volatility market zone, right? So all of this, the pushes and the pulls of liquidity and real demand are going to create high volatility. Do we end at the same price 6 or 9 months from now? Very possible.
Very possible. Okay. The only antidote to this, or the antithesis to this, is if liquidity really picks up, right? And there are, one argument that I got at the recent JP Morgan conference, which a few people made, Jitu, was this, that there are funds which are sitting pretty at the 5.25 rate or higher than that in fixed income US Treasuries, which, as the rate easing cycle begins, will move searching for greener pastures, because they don't want that number. They want a higher number. They don't want the 4% number or 4.5% number or even a 4.75% number. And if that liquidity were to find its way into emerging markets, as you could argue traditionally has happened, could that keep markets afloat or maybe even more inflated?
It's so when you typical rate cut cycles, money is going to come into EM. Okay, with no debating that. Does that happen this time around? I think so. Is that what creates the positivity? Yes. Are domestic flows going to create positivity? Yes. Is the supply side heavy? Yes. And but valuations are stretched. So at some point, someone's going to walk. And so can markets be 5-7% higher 6 or 9 months out? Absolutely. But do you kind of see the geopolitical side just cracking globally? Is that a possible risk factor where the winds change and people get scared and run? Possible. I don't know. So I'm saying there are a lot of factors.
Could the reverse happen, Jitu? If there's a Trump presidency, if there is a pause in the wars across, right? Because the world has learned to live with geopolitical conflicts. The crude behavior is a sign that geopolitics doesn't seem to be worrying the world anymore.
So your words to God's ears, I hope. I think, seeing such large human lives loss is not good. Markets aside, I think, yes, markets would be pleasantly surprised if that happens. But again, all my models are saying the valuations are stretched, businesses are not doing well. In fact, I'll just make one point. There are 3 places in the world in a very weak global economic environment that seem to be doing well, right? Japan, India, and Spain. Do I understand exactly what's going on in Spain? Not enough. But the point is there are 3 places out of 43 markets in our models that look decent and the rest are in really, really bad shape. In my view, there are air pockets not yet hit the results data, and we're going to see really lousy numbers going forward.
Yeah, that's the other thing though. And just before we come to that, Jitu, just wondering, is this where you are at, for lack of a better word, loggerheads with the common market wisdom that when the numbers start coming in, the world will wake up and smell coffee?
I think,
or is it somewhere else?
No, I think this is one big piece, right? The fact that valuations are high and the numbers are going to be much lower than what markets think. I think that's one area where I disagree with the markets. Can liquidity prove me wrong? Absolutely. Am I going to be humble enough to change my view and say, yes, there's an economic cycle that bottoms in March 25 and turns, and we're going to be looking great in December 25, and I'm going to price it through liquidity now? Well, I could be wrong, and I'm happy to be proved wrong in that scenario. But you need to understand that this is what the milestones look like. You can jump a few milestones and go out 18 months out, but I'm not so aggressive. I'm a little cautious right now, saying we've had a good run. Year-to-date numbers in the US 16%, right? Normative numbers are 8-9%, and with the data not looking that good. Every rate cut cycle is a reason, because economy is not good, companies are not doing well, the consumers are hurting, and you need to cut rates, and that's what's happening.
Yeah. So how do you play India in such a scenario then?
So in my view, India's had a phenomenal run. I mean, watching markets for 30 years, this is, where there's huge froth in a lot of small parts of the market, the SME market and other parts of the market. Markets are really frothy, right? As I see it. How do you play this? In my view, the one big difference you make is global cyclicals. You need to be extremely cautious, and domestic-driven parts of the market, you need to be constructive. That's one big thesis. Second thing, what do I expect? I think liquidity gets much better. Now, what was the malaise of the banking system for the last 12 months? Liquidity was really tight. When that eases, there's more deposits that go into the banking system. The banking system starts lubricating faster. Growth comes back. Our banks have been the cheapest they've been in a long, long time. So do I think banks do well over the next 6-9 months? Yes. And I think the domestic side still has some legs to it. Hopefully that turn, but I'd be very, very cautious on the global cyclicals.
Okay. Before I come to global cyclicals, because you mentioned banks, is the investing, I know Jitu Punjabi is a guy who invests for growth. I'm hearing a Jitu Punjabi talk about banks from a valuation perspective, not from a growth perspective. Why is that?
No, I think, so when I see, also let me, that hasn't changed. The fundamental growth investing hasn't changed. We're seeing huge opportunity in a lot of sectors where there's entrepreneurship raging, okay? You see the air conditioning, manufacturing with PLIs, you see the EMS stuff, you see a lot of smaller companies doing dredging, companies doing other stuff. All of that continues, and that's driven by entrepreneurship, that's driven by energy, that's driven by domestic demand, that's driven by policy being supportive, and that's driven by an Indian economy growing and doing well. None of that changes.
Got it.
Okay? What I'm saying is, when you're looking from a big asset allocation standpoint and thinking, what do? I think the easy one is financials.
Okay, yeah. Well, low-hanging fruit, the low ball, if you will. Okay,
yeah.
Great. Okay. Do you sense, that the financials, if the financials have to make money, the money will be made by valuation repricing as opposed to growth? Because if everything that we're talking about is something that even entrepreneurs identify with, then the much awaited private capex cycle might just take that much longer to kickstart. In fact, also on that point, Jitu, would love to understand from you. There's a lot of voices that we picked up at the JP Morgan Investor Conference again, that if indeed tariffs come about, then China dumps its goods, which it was sending to US, to Europe, etc. and stuff like that. But if that gets curtailed, it goes into the EM and the Asia Pac, and it deflates the end product prices in areas where Indian manufacturers might have wanted to step up capacity. So is the private capex cycle under a bit of question mark in the very near term?
So, when you look at the macro data and try to look for the private capex cycle, the answer is what you're saying.
Okay.
It's coming, not yet come.
Yeah, exactly.
But if I go down to the companies we're looking at closely and say, what are they doing in terms of capex? Are they putting money on the table? The answer is yes. Are they putting it in very capex intensive industries? The answer is no. Are they doing it where India has a demand side and not enough of a supply side to be met? The answer is yes. So when I look at the macro data, I kind of say, oh, the capex cycle is still not here. When I go and see the operating companies, they're saying, oh, we're adding capacity. We need capacity. We're adding capacity. Do you think the global cyclical commodities, which are fungible globally like steel and other stuff, are you going to see pressure points there? I think there are pressure points, but India's adding capacity there too. So the answer is somewhere in between, that the macro data is showing you that it's taking some time, but certain businesses and certain industries, it's happening as of yesterday.
Okay. Okay. Which themes? Because I heard you say that dredging might be some positive, but where is it that you see business confidence being very high or high?
So, you look at the manufacturing side. Okay.
Very wide bucket.
You look at the air conditioning and electronic manufacturing side.
Okay.
10 years ago, how many ODUs were made out of India from China? India, the market size was 20 million units. One factory in China was 20 million units. Right? Today, you're seeing the capacity in India has come up to 35 million units. It's all happened in 6-7 years. Are you going to see that scale up? Did you see that scale up coming? I don't think so.
Right.
Was there a bit of government help? Yes. Were there PLIs in place? Yes. Do I see each of the large international OEs taking up PLI and setting up manufacturing here? Yes. Are there suppliers into that manufacturing chain? Yes. Are there opportunities to find and invest in alongside? Absolutely. And that's what I'm saying. So there are chains, there are food chains in the industrial side and manufacturing side where we're seeing huge opportunity.
Got it.
Even in the solar side, right? So yeah, the polysilicon companies, the top 2-3 companies in polysilicon in China are hurting. Their profits are really hurt. They're trading at 0.2 times, 0.3 times book value. It's like death over there, right? And here you're seeing a completely opposite picture. But are you seeing Indian companies who are executing on the Indian solar dream and growing at 100, 150% per annum? Are they doing well? Yes. So you've kind of found that the government has helped ensure these guys stay alive, do well, use the pain in China, get the stuff in, and then slowly integrate and build greater capacities. It's going to take some time, but it's happening.
Okay, so manufacturing is your favorite. What? Just one quick question before the last couple of questions, maybe. One is, I heard you say that global cyclicals are at a void. What about IT services? How do they fare?
I don't have a strong view. When I see the advisories coming out of the big guys globally, it kind of is nervous. When I see the hiring data coming out of the Googles and Amazons and Facebooks, it's telling you things are hurting. Have we seen a change over there? So once they start hiring, you know that this scale is going to get faster. But I think people are nervous, and I'm supportive of that, saying let's wait, let the global economy turn. It's going to take 6 or 9 months. My starting point is the world is not in good shape. The data is going to show it in the next 3-6 months. Once you're somewhere near the bottom, you have a business cycle bottom, you have a market cycle bottom. That'll be the time to get in.
But the bottoms now could be a lot quicker to arrive at. You believe this could happen in the next 6 to 9 months, and then the cyclical recovery could come back as well.
Let's wait for the data. I mean, at this point, I can see there's downside that's not priced in. Let's wait for a bit of pain, and then we talk about
pain in India be exacerbated by the valuations that we are trading at, or is the wall of liquidity going to ensure that the dips are not so large?
I'd lean on the latter. The fact that there's 2 lakh crores of liquidity with the mutual funds, there's a lot of money coming in every day. Is that going to buffer some of the pain if possible? Yes. But, when, let's say, a company reports a 50% fall in earnings, that company's toast. So I'm going back to saying this is a bottom-up market over the next 6 to 9 months. Focus on your companies. There'll be some guys who do really well, some guys do really badly. Focus on your companies. Focus on who's doing well within a sector as well.
Perfect.
Execution's going to be tougher, and be careful about certain sectors.
Okay, got it. Jitu, thank you so much for taking the time out and being with us on Talking Point today.
Appreciate it. Thank you.
The pleasure was ours, viewers. Thanks for tuning in.